Yes. Hello all, welcome back to BCCA. I am Rajesh, your faculty for SCM and DM. See guys, this is our EO batch for SCM and DM. In CMA Final Group 3, so to clear Group 3 in CMA Final, so one of the easiest and scoring subject is SCM and DM, sir. What? Volume తగ్గించాలా? Increase, okay. In CMA Final Group 3, SCM and DM is one of the easiest and high scoring subject. Okay. So if you are good with practical subjects, practical concepts and all, if you are good in those kind of concepts, means you have to target SCM and DM, SFM to get exemption more than 60, so that we can clear Group 3. If you are clearing Group 3 means clearing Group 3 is also very much easy. Okay, or else if you are good with theoretical parts, then you have to target a law and DT. So there you can get so more than 60 marks, so that we can easily clear Group 3. See, so coming to our subject SCM and DM. So first of all, I'm assuming like you all know the index of this particular subject, sir. Okay, there are two parts in SCM and DM, SCM part and DM part. SCM 60% of weightage, DM 40% of weightage. In SCM we have chapter number 1, introduction to SCM, chapter number 2, quality cost management. In next one, chapter number 3. Chapter number 3 is decision making techniques. So in that decision making techniques, we have marginal costing, relevant costing, pricing decisions. Marginal costing, so practical kind of chapter from which we can get 14 mark question. Relevant costing, so most probably we will get a 2 mark MCQ. Out of last 4 attempts, only one attempt they have asked 14 mark question from relevant costing. Instead of asking marginal costing, 14 mark question. And the pricing decisions, they are not even asking any theoretical or practical or MCQ, or also they are not asking, just some pricing strategies. Okay, 2-3 strategies are there, that's it. So now coming to 3.3, transfer pricing. In every attempt, sure short question. Next one, 3.5, target costing, product life cycle costing, asset life cycle costing, decision making using probability. So next, chapter number 4, activity based costing system, ABC, just in time, throughput, backflush, benchmark. So out of these 5 chapters are there in chapter number 4, but activity based costing, just in time, throughput, from these 3 chapters only they will ask 1 7 mark question, practical problem, 1 or 2 MCQs. Okay, next one question for chapter number 5, this is standard costing. Okay, sure shot 14 mark question. Next, in DM part, decision making part, we have chapter number 6 to chapter number 15. Chapter number 6, linear program planning, transportation, assignment. So 10, simulation. These 4 chapters we have already, so you might have already learned in same inter level, but whatever it is, we will discuss here from the basics. Chapter number 11, network analysis. This is also there in inter. Chapter number 12, learning curve. So 9, game theory. 13, maxima minima, business forecasting, introduction to tools for data analytics. This 15 is a complete theoretical part. From that chapter we will get 2 MCQs. Okay, so this is index, sir. So first of all, we need to understand question paper pattern for every subject. If you understand the question paper pattern, means anyway we'll be having 2 choice in each paper, no? So we have to write 5 questions. So which chapters we can take choice, which chapters we have to target and all. So first of all, you need to know the question paper pattern. So that's why, so first of all, let's go through that question paper pattern. For any subject, whether it is intermediate or else final level, any subject, so question paper pattern is same, sir. 8 questions will be there. Question number 1, complete MCQs. Any subject, final level or inter level, any subject, question number 1, MCQs, 15 MCQs, 30 marks. So in SCM and DM, question number 2 is sure shot 14 mark question from marginal costing. Out of last 4 attempts, 3 attempts marginal costing, only one attempt they have asked relevant costing question. Next, question number 3. So question number 3A, 7 mark question from transfer pricing, sure shot. For any attempt, any MQP, any MTP, they are asking only transfer pricing question, 3A. 3B, so here we have 4 chapters, target costing, asset life cycle, product life cycle, probability. From that 4 chapters, we can expect 1 7-mark question. 4 are small easy chapters only. Next, coming to question number 4, for this question number 4A, from chapter number 4, sir, ABC, throughput, just in time. From these 3 chapters, we can expect 1 7-mark question. 4B, theoretical question from chapter number 1 or 2. Question number 5, standard costing. So most probably in last 4 attempts, 3 attempts they have asked reconciliation question. Okay, even though here in this chapter number 5, standard costing, we have so material cost variance, labor cost, all the variance calculations and all. Next, we have investigation of variances, planning variance, operation variance. Some small concepts are there, but okay, so we need the concept of variance calculation and all for doing reconciliation problem. Okay, so reconciliation, coming to reconciliation, we have 2 or 3 models are there. From those 3 models only, last 3 attempts they are asking the questions, sir. Okay, next, you don't worry, I will share this PDF in the group. Okay, yeah, I will share. Question number 6, question number 6, 7, 8, these 3 questions are from DM part. Okay, 6A, LPP transportation assignment. Okay, so but most probably they are asking assignment problem here. But in last June 25 attempt, transportation Vogel's approximation method, some basic question they have asked, sir. That too in assignment, so traveling salesman question is being asked. For 2 times they have asked traveling salesman question. LPP till now they haven't asked, but there are chances in LPP, LP model writing, some equations writing, that model only enough. Okay, question number 6B, simulation. Sure short question for any attempt, they're asking simulation question only. Question number 7, network analysis. From last 4 attempts, network analysis, only 2 models, program evaluation review technique or else crashing. If you learn the 2 models means you can write 14-mark question. Next, question number 8A. 8A, game theory or maxima minima. Easy chapter, small chapters only. That maxima minima is also there in SPMBV. SPMBV in SPM chapter number 3, economic efficiency of firms is there. Same concept, same questions here and there. If you learn this chapter here, so if you are writing group 4 as well, so then in chapter number 3 of SPM, we will get 1 7-mark question. So if you learn here, maximum minima 7-mark question, and in SPM also 7-mark question. Okay, so question number 8B, sure short question, sir. Business forecasting. In this business forecasting, we have 4 models only: regression analysis, exponential smoothing, and seasonal indices, moving average. From that 4 models only, they have been asking questions. 2 attempts, regression analysis, y is equal to a plus bx. So that concept you might have learnt in intermediate OM demand forecasting. Same questions, same intermediate level concept, and final level concept is exponential smoothing. Last 2 attempts, 2 times they have asked exponential smoothing question. Okay, so this is question paper pattern. Now we have to decide question number 2 to question number 8, 7 questions are there. Out of these 7 questions, which questions we have to write? Means, okay, we have to select the chapters which are easy for us. Okay, so most probably, so I will discuss all the questions, all the chapters in the regular class or else EO batch or else fast track. But so most of the times I won't suggest you to go for question number 2, sir. Directly, if you are so taking question paper and attacking question number 2 means gone. Gone means marginal costing question. So whatever the number of questions you practice in the examination, they will ask a new question. Okay, we can write so with some basic concepts and all, we can attempt that particular marginal costing question. But the problem is like we won't, case study kind of questions are being asked, we won't understand, you won't get where to start the question, where to end, what are the point we have to understand. So understanding that question and all, it will take time. Okay, so if you are attacking that question at the beginning of the examination means you will take 30 to 45 minutes. Okay, so after 45 minutes you will realize for this 45 minutes I've only written that 14-mark question only. So then you will start fearing, you will get scared. Okay, with remaining time I have to write that much things, that like you will be getting somewhat fear. So to avoid that fear and all in the examination, first of all we have many small chapters. Okay, some chapters are format based only. Okay, so coming to question number 6A, assignment. Step 1, step 2, step 3, step 4, step 5, like that some series of steps are there. If you are following that steps means nearly 80% of question is over. Format based question. Simulation, 2 steps are there. So random number range writing. Okay, so simulation worksheet writing. Some series of steps. Coming to question number 7, network analysis. That is also program evaluation review technique, network diagram writing, some formulas, crashing, some series of steps will be there. If you follow those steps, even in question number 8, maxima, minima, business focus, series of steps will be there for DM. So format based chapters, format based questions. If you learn those formats means definitely we can write those questions. At least 80 to 90% we can write. Okay. So I'm coming to SCM, standard costing. So we have to understand some concepts and all. Okay, if you practice past paper questions and all, we can write that question. Question number 4, ABC. So most probably they're asking ABC or throughput. In throughput also only one model, optimal product mix calculation. ABC, standard format only. Okay, and theory, some theory questions, repeated questions are being asked. Question number 3, transfer pricing. These 4 chapters are question number 3B, small chapters, sir. Okay, if you learn these 6 questions at least, okay, anyway we will have 2 choice now, so you can leave 2 choice, 5 questions you can write. Okay, we will learn MCQs. Okay, MCQs, coming to MCQs, sir. Institute has already released one MCQ booklet. In that we have 200 to 220 questions. From that questions, in each attempt, in the examination, 10 to 12 questions are there. Okay, that means considering all these questions and past paper questions, MQP questions, so I have prepared one material. In that we will be having some 250 to 300 MCQs. Okay, so we will discuss those MCQs. Enough. Definitely sure shot you can attempt 10 to 12 MCQs. Okay, learn those 250 MCQs. Okay, so go to the examination, directly identify 12 questions, answer. Okay, you will get 24 marks. Okay, in first half an hour, if you get that confidence, like yes, I will get 24 marks. If first half an hour itself you are getting that confidence, means enough. Exam is over, you will definitely get 60 marks. Okay, so next one, selecting question is also important, sir. Okay, that's it. So I have done some analysis of past 4 papers, MQPs, MTPs and all. See, this is the analysis, sir. For each question, last examinations. Okay, June 25 exam. For June 25 attempt, MQP1, MQP2. December 24 exam, December 24 MQP1, MQP2. June 24 exam, MQP, 1 MQP only there. For June 24, December 23 exam, December 23 MQP1. Okay, so how many papers? 1, 2, 3, 6, 9, 10 papers, sir. These 10 papers, these all are the resources we are having for new syllabus 2022. I have done all the analysis for these papers. If you see that question number 2, so marginal costing question, except one December 23 exam, relevant costing question. So if you observe, even in marginal costing also, they are asking what, sir? Accept or reject, okay, make or buy decision, pricing decision. Okay, 3 models: accept or reject, make or buy, pricing decision. One more important model is there, that is a limiting factor model. Limiting factor means optimal product mix rating. Okay, even in marginal costing, if you prepare those models, okay, definitely they will ask a case study kind of new question. Okay, with that concepts, at least you could able to write 60 to 70% of the question. But we cannot, so as case study kind of questions are asked, it will take time. That's why I'm telling marginal costing, leave it, keep it for last. Okay, next one, question number 3A, sir. See this question number 3A, transfer pricing, any attempt, any paper. Transfer pricing. In the transfer pricing also, some internal external purchase decisions, limiting factor, make or buy, return on invest based transfer price calculation, transfer price method. Some models are there, 4 or 5 questions are there. If you learn those models, means we can write transfer pricing question. Okay, next one, question number 3B. See here, we have 4 chapters for 3B, right? Target costing, recent attempt they have asked. Previously, asset life cycle costing. And so if you observe, 1 minute. See, out of last 4 attempts, target costing, target costing, target costing, target costing. So 2 attempts, sir, 2 main attempts, they have asked target costing question. So asset life cycle question was asked in this attempt, and the probability question. That's it. So you can see probability. So basic only one question, sir. Okay, writing break-even point, probability of achieving break-even point model, one question is there. That one question has been asked in December 24 attempt and 2 MQPs. And asset life cycle question, only one model. If there is a life disparity, so same asset life cycle is nothing but investment decisions in SFM that you might have already learned in FM capital budgeting. Okay, so if there is a life disparity in assets, we need to take the decision based on so equated annual cost. Okay, that model, sir. 3 item that model target costing questions. Okay, so that means our target is to learn target costing, probability, asset life cycle. Anyway, we have product life cycle chapter, two questions only there in product life cycle. Okay, so if you learn these basic concepts on 4 chapters means we can write this question. Now coming to 4a, 4a, abc 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 basic question. Or else throughput costing, product mix, product mix, product mix. In throughput bottleneck elimination strategies. That means in throughput costing total 4 models are there, sir. 3 models. Product mix rating, so bottleneck elimination strategies and some formula based questions. Okay, 3 models. ABC means only single model. Okay, so calculation of absorption of overheads under activity based costing system. Okay, one attempt not in main attempt, but in one MQP they have given just in time question. Okay, so our target for question number 4a is 3 chapters only, ABC, throughput, just in time, enough. Okay, now question number 4b. See here, so if you observe theoretical questions, TQM last attempt COQ theory, sir, cost of quality theory, prevention cost, appraisal cost, some basic theory is there. Theoretical question was given. So next one here, COQ theory, TQM principles, lean accounting 2 times, principles and practices of lean accounting, phases of value analysis, significance of lean accounting. So if you observe what are the major repeated concepts, lean accounting, uh, so lean accounting, value analysis, TQM, COQ theory. That means 4 concepts. Okay, apart from that, we'll have 2 more concepts. If you learn those concepts means enough. Okay, we can write this theoretical question as well. Okay, in from chapter number 1 or 2, so maximum we have 10 to 15 questions, sir. The 10 to 15 theoretical questions if you learn means enough. Okay, now question number 5. Question number 5, so reconciliation reconciliation out of last 4 attempts main examinations, 3 times reconciliation question, one time so 2 small questions was asked, that is one attempt they have asked the reconciliation, sir. So this one. Okay, so June 23 is missing, right? Okay, see, a small question, sir. Middle cost variance calculation, fixed overhead variance calculation, labor cost variance, fixed overhead cost variance calculation. Okay, that variance calculation 2 7-mark questions, or else reconciliation 14-mark question for question number 5. 6a, for 6a, transportation Vogel's approximation method. So in transportation, till stage 3, Modi's optimality test was there, sir. That is some lengthy problem, but they are not asking that much lengthy questions, sir. Okay, so what they're asking is like some basic Vogel's approximation method. By using that method, calculating initial basic feasible solution. LPP, 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 LPP. So in MQPs they have given, but one examination they have given linear program planning, LP model writing only, one model only. So assignment, traveling salesman, minimization 2 times. 6B, simulation question only. Simulation. We will learn simulation, we can definitely write this question. Next one, question number 7, network analysis. Okay. So network analysis, either program evaluation review technique or else CPM. But in some MQPs, in MQPs only, they have given network analysis, some network diagram drawing and learning curve question was given. But so we are not expecting like learning curve question will be given in the examination, but whatever it is, we will try to learn this chapter as well. But so most probably question number 7, network analysis, program evaluation review technique or else CPM. 8A, maximum minima or else game theory. Maximum minima or else game theory. This is the analysis. Now 8B, business forecasting. So y is equal to a plus bx, regression analysis questions or else exponential smoothing, seasonal index. Okay, moving average, 4 models, sir. So regression analysis, okay, exponential smoothing, seasonal index model, and moving average. That's it. If you learn those 4 concepts, 4 questions enough, you can write that 8B. So 8A also same like that, sir. Okay, this is a past attempt paper analysis. Okay, as per this analysis, we can definitely understand like some repeated models are being asked. Okay, if you learn that models conceptually and at least prepare one problem for one concept. So preparation means practice. Ravi sir might have told you already. Okay, practice is more important. Okay, so we can so give some super 50 or super 100, whatever the so EVO classes or else in even in marathons, whatever the questions, guest questions we discuss. But so even those questions are coming in the examination. Most of the students are not able to solve those questions in the examination. Why means they are not doing practice. Okay, so if you practice the questions which we are going to discuss in EVO class, okay, enough, enough. That's it. Mm, so now our target is for 5 days, 5 question syllabus at least we shall try to cover. In today's class, we will try to cover this question number 3, sir. Question number 3. That means we should start with this small chapter: target costing, product life cycle, asset life cycle, probability in decision making, transfer pricing. Okay. See, let's go to first of all SCM and DM. This SCM and DM is somewhat a hybrid subject, sir. Hybrid subject means it is having the concepts from in SCM we have concepts of SM, strategic management, okay, and we have the concepts of CM, that means cost management techniques. DM means complete OM techniques. Okay, so SCM and DM is a cocktail, somewhat cocktail of strategic management, cost management, operations management. Whatever it is management only. We have all these techniques in this SCM, sir. Okay, now why we have to learn this SCM, sir? Why we have to learn this SCM means, so for any organization there will be one objective. So in strategic management you might have learned that vision, mission, objectives and all. For any organization, any business, they will have one objective. So what is that objective means? So directly they will try to get profits only. Profits. Business objective is to get profits. Okay, so how to get profits, sir? How to get profits means to get profits, the basic thing is like customer satisfaction. Customer satisfaction. So customer satisfaction means what, sir? When a customer will get satisfied. When a customer will get satisfied means, okay, so tell me, sir, as a customer, when will you get satisfied with a product? Okay, you purchased one product, so let's say one mobile you have purchased. Okay, recently iPhone 17 is released. Okay, if you purchase that mobile, okay, when will you get satisfied with that product? Quality. Yeah, advanced features, that means quality. Quality and so new advanced features and all. Okay, and durability. So that comes under quality. Okay, so and the price, nice. Price, less price, after sale services, after sale services or else um, shortest delivery times and all. Okay, if these qualities are there means, okay, you will get satisfied. Okay, first of all, coming to this price, sir. So if you as a business owner, as a business CEO of particular business, you know, if you want to sell a product at lesser selling price, okay, to fix a selling price at lower prices. Lower prices means what, sir? Price is equal to cost plus profit. Okay, so if you want to so reduce the selling price means, okay, you have to reduce the cost. Okay, you won't compromise on this profit. That means we have to reduce the cost. How to reduce the cost and all? Okay, that is the point. If you reduce the cost, if you could able to reduce the cost means, okay, so you can able to make more number of units sale. You can sell more number of units. Selling more number of units means profit also will get increased, right? So that means our target is to here, our target is to either increase sales or profits, reduce cost. That is called maximization or else minimization. Entire SCM and DM is talks about either maximization or else minimization. What we have to maximize, sir? We have to maximize the sales. To maximize the sales, what we have to do? What kind of strategy we have to follow? Okay, so price differentiation strategy, product differentiation strategy, cost minimization strategy. Different strategies are there in SM. Okay, and coming to cost minimization. So entire OM and entire DM part, entire SCM part is for cost minimization only. Okay, so quality, to improve the quality of product we have, so chapter number 2 we discuss about cost of quality. So different techniques are there to improve the quality of a product. So that is total quality management, TQM. Okay, so we have techniques like benchmarking, business process reengineering, lean accounting. All those techniques are to improve the quality only. Okay, next, services. What kind of services means, if you want to deliver, so in this services also, after sale services, we need to consider the cost as well for after sale services. For that also, this that was also discussed in cost of quality concept, chapter number 2. And if you want to deliver the product within within less time, less delivery times means, okay, again there are some concepts, supply chain management and value chain management and all. Okay, so to give the customer satisfaction or to increase the profit, to reduce the cost and all, we have some techniques in SCM and DM. Okay, so for this maximization or minimization, so as a top level management, let's say assume yourself as a top level management. Whenever you are learning this SCM and DM, imagine yourself as a CEO of a company. Then only so you can understand this subject even more easily. So top level management, they will do two things, sir. On daily basis, they won't go to the factory and work. Okay, what they do is like they take decisions. Decisions. So what kind of decisions they will take, sir? Whatever the decision they will take, their decision objective will always be to increase the sales or to reduce the cost. Okay, so they will take some decisions. They will give, so they will direct lower level or middle level management to implement these decisions. That means they will direct the lower level employees management to implement the decisions. Implementation. So decisions, policies, guidelines, decisions will be taken by top level management. Those decisions will be implemented by lower level management. So that means you are giving some policies to be followed by lower level management. So decisions are taken by top level management, should be implemented by middle level, lower level management. So once the decisions are getting implemented, so top level management has to check whether that decisions are being implemented as planned or not. That means they have to impose some controls. So in entire SCM and DM, total techniques are either decision making techniques or controlling techniques. Okay, what all the techniques we have for this maximization or else minimization means complete DM techniques. Complete DM techniques. So linear program planning, product mix decisions, transportation, to minimize some from where to where we have to transport raw materials and all, transportation decisions, assignment, which job has to be allocated to which person, decision. Okay, simulation, so demand forecasting decisions. Okay, so future forecasting decisions and all we take by simulation. Network analysis, if you are dealing with projects and all, so how to reduce the cost, what is the lead times, what is the floats and all. For that, network analysis is the technique. So game theory, when you have multiple alternatives, which is the best alternative for you, decision making. Okay, business forecasting, so for future forecasting and all. Okay, so maximization or cost minimization. DM techniques are decision making techniques. Entire DM techniques discuss about either maximization or else minimization. Next, in SCM, all the concepts are decision making techniques only, except controlling techniques. Are two techniques are there, sir. That is, first one is standard costing. Second one is transfer pricing. Two controlling techniques are there. Apart from two controlling techniques, a complete SCM techniques are cost reduction, cost minimization techniques only, or else sales maximization. Okay. See, coming to standard costing or transfer pricing, these two are controlling techniques. What kind of controls means? Nothing but performance evaluation. In these two techniques, at the beginning of the period itself, we give some targets or conditions to the employees. Let's say, for example, standard costing. What is standard costing, sir? At the beginning of the period, you fix some standard cost. At the end of the period, you will get actual. Standard actual difference is called variance. Okay, if that variance is favorable variance, fine. Okay, so management are working efficiently. If that variance is adverse variance, top level management will question them why that a very adverse variance occurred. Okay, what you are doing, you are not working efficiently, so they will take some penalization decisions and all. If they are working efficiently, so some what we call it as a bonus incentive schemes will be there. Okay, that is so in transfer price also, that is also for performance evaluation of departments or divisions. So in this SCM, target costing or else relevant costing, ALC, PLC, chapter number 3 techniques, chapter number 4 techniques are cost minimization techniques only. Okay. So in SCM, entire parts are again, this cost minimization is divided into cost minimization. So this cost minimization is divided into two types. One is cost reduction, another one is cost control. You know the difference between cost reduction and cost control. What is the basic difference, sir? What is cost control? What is cost reduction? Cost reduction means complete permanent reduction in cost. Okay, so cost control means it's a temporary. Let's say, for example, in this classroom, if you want to so control the cost, electricity cost. What cost means? Let's say electricity cost you want to minimize. There are two approaches. Okay, one is cost reduction, another one is cost control. So coming to first one, cost control. If you want to control the electricity cost, okay, you have to give some instructions to the in charges and all. Okay, whenever the class started, then only switch on the lights. Okay, then only switch on the AC. If class is over in the evening, okay, switch off all the lights and ACs. Okay, then if you are so continuously following these guidelines and all, cost will be in control. Okay, so if the in charges are not switching off these lights, ACs and all means, then cost will increase. Okay, as long as you follow that guideline standards, then only cost will be in control. Okay, some guidelines or standards targets will be there. If you follow the targets, cost will be in control. Cost control. Okay, so cost reduction. Now if I want to reduce electricity cost, what I can do, sir? What I can do is like I can remove that AC so that no one will use AC, so cost permanently reduced. Okay, remove that multiple lights are there, so why we need all these lights? Okay, remove those two tube lights at the end. Okay, so that we can reduce the cost. Okay, this is basic difference between cost reduction and cost control. So cost control techniques, nothing but these two techniques are cost control techniques. This all these SCM other techniques are cost reduction techniques only. Marginal costing is main technique to reduce the cost. Okay, so in this all these decision making techniques or else cost reduction techniques, we shall start with target costing. So our first chapter, target costing. Our target is here. Question number question number 3B is our target, sir. Now, so for this question number 3B, we have 4 chapters: target costing, asset life cycle costing, product life cycle costing, probability in decision making. Okay, small chapters, 4 chapters. Okay, so first let us start with this target costing. So target costing, it is also some kind of costing. What is costing, sir? Yeah, excellent. That is costing, right? Okay, what we do in costing means, okay, we calculate the cost, calculation of cost, okay, calculation of selling price, calculation of profit. Okay, so these are the some basic objectives of costing. That means costing objectives. So you might have learned these objectives of costing. 5 objectives are there. Okay, so ascertainment of cost, ascertainment of profit, ascertainment of selling price. Okay, basic objectives. Apart from that, we are having cost reduction, cost controls. Okay, see, in costing we calculate cost, calculate selling price, calculate profit. Okay, let's say, so we have to fix the selling price. How to fix the selling price, sir? Selling price, how to calculate the selling price? Generally we calculate, first of all we calculate cost. Okay, so what is the cost to produce a product? We calculate all that cost. So to that cost you add your profit, whatever the profit you want. Okay, that profit element you add to that cost, so that you will get what? Selling price. That's it, that is costing. Okay, now what is target costing, sir? Here, while calculating that cost, okay, so whatever the cost we incur, we add that cost here in traditional costing. But here in target costing, okay, so we set some target, sir. We set some target. With the target of cost only, we try to produce the product. Okay, so generally in um, the external market or industry, there are two types of markets are there, sir. Markets are of two types. One is called as sellers market. Sellers market. Second one is buyers market. Sellers market, buyers market. Sir, what is sellers market, sir? In that market, all the sellers are there. Not like that, sir. If many sellers are there means that is called sellers market, not like that. But so what is sellers market means? Okay, sellers markets are some kind of a monopoly where only one seller will be there, huge number of buyers, or else oligopoly or duopoly. That means few sellers or two sellers are there. So huge number of customers will be there. Buyers market means huge number of many sellers will be there, many buyers will be there. Some example of buyers market is vegetable markets. Okay, so in this kind of monopoly kind of markets, monopoly or else oligopoly, duopoly kind of markets, what will happen means, while fixing selling price, how they fix selling price, sir? How they fix selling price means, as there are no multiple competitors, they are only the supplier of that particular product, they calculate the cost. Okay, to fix the selling price, first of all, they will calculate a cost. Whatever the cost they have incurred, they add all that cost, they calculate total cost. Plus the profit required by them, whatever the profit they want to add, that profit they will add, so that they will fix selling price. Okay, this is so traditional approach, sir. Okay, so in buyers market, so what will happen to buyers market means, any sellers market, so over the period of time it will be converted into buyers market. How, sir? How means, see, if there are no entry barriers, exit barriers, new competitors can come into the business, they can do the same business. Let's say for example you have started one business, whatever it is, you started one business. Okay, if your business is getting profits means, immediately, so other persons, new entrants will come into the same business. Let's say for example you have started some pani puri shop nearby road. Let's say some tiffin center you started, sir, nearby road. Okay, so if you are getting profits, immediately, so new entrants will come, so new persons will start a same kind of a tiffin center beside you. Why, sir? Why means if any business is growing, getting profits means new competitors will come into the business. Okay. So that means once that is a seller's market, that slowly will convert into buyer's market. Okay. Now new competitors are coming into the market, sir. New entrants. Once new entrants are coming into the market, what they will do is like they will reduce the selling prices. That is what happened in telecom industry. Jio entered into the market, they have fixed lesser selling prices. Okay, so like that. So let's say for example, originally, so cost structure is like this, sir. Selling price is selling price 100 rupees. How that 100 rupees means cost is 70, cost 70, profit is 30, sir. This is our original cost structure in sellers market. But so new entrants coming into the market, what they have done is like definitely they will fix selling price lower than our company now. Say for example, now to sell more and more units, they have fixed 90 rupees selling price. New our competitors are our competitor selling price. Competitor has fixed selling price lower than our selling price. Then, so if you keep selling at 100 rupees, what will happen, sir? All the customers will go to the competitor now. Then, so to avoid that competition, I also need to change my selling price to 90. Our company will also need to change the selling price to 90. Okay, so we reduce the selling price. But so what I will do is like I won't compromise on my profit. I will reduce the selling price. But the 30 rupees I'm not ready to lose per unit profit. Okay, now what we have to do, sir? Your selling price is what? Your selling price, your new selling price is 90. Your profit is 30. So selling price 90, cost profit 30. What is the cost? 60. 60 is the cost. That means you have to reduce your cost from 70 to 60. This 10 rupees you need to reduce now. This 10 rupees is called target cost reduction. Target cost reduction. This 60 rupees is there now. This is called as target cost. Target cost. You are fixing some standard target. You are trying to achieve the target. Okay, so how to achieve the target number is called target costing. Okay, 1 minute. This 90 is there now. This 90 is called as target selling price, sir. Target selling price. This 30 is our target profit. Target profit. Okay, so as competitors reduce in selling price, we also reduce the selling price. We also need to reduce the selling price. If you are reducing the selling price at the same time, you won't compromise on your profit. Okay, so then what you have to do is like you have to reduce your cost from 70 to 60. 10 rupees cost reduction you have to do. So how to reduce the 10 rupees, sir? That is only the concept. Entire SCM and DM is to reduce the 10 rupees cost. Okay, so we can use whatever the techniques we are learning in SCM and DM. Okay, so we can use either so activity based costing system, marginal costing, relevant costing in DM, so assignment, transportation, simulation, all those techniques, any technique. So whatever the technique possible, use the technique, try to reduce the cost. That's it. Okay, now many many concepts or techniques are there to reduce the cost 10 rupees. Okay, so first one, so theoretically we have some value analysis. Value analysis means we will identify the activities. Okay, from each activity, how much value is getting generated. Okay, if any activity is not generating any value, eliminate that activity so that we can reduce the cost. Value analysis, value chain analysis. Okay, so another thing we're having is value engineering. Value engineering means again, so engineer the design engineering, functional engineering, like the two concepts are there, sir. So design engineering, process engineering, we call it as. So in that process engineering also, we perform some series of steps to produce a product. Okay, so in those series of steps or processes, so eliminate the unnecessary process which is not adding value to the product. eliminate that one. Okay, so see, this is one of the important concept. So first one we have to reduce the target 10 rupees. First one value analysis. Second one value engineering. What is value engineering, sir? Value engineering, we have two types of engineering: process engineering, second one design engineering. Sir, what is process engineering means? So identify all the process to produce a product, eliminate non-value added process, we can reduce the cost. Design engineering, here we have functional engineering, non-functional engineering. Non-functional. Functional engineering, non-functional engineering. So functional, non-functional engineering means what, sir? Let's say, for example, this podium is there, sir. Okay, so what is the what is the main core function of this podium means? I need this podium to keep my tab here or to keep some system here so that I can write it over here. But so if you observe, unnecessarily they have kept one more wooden sheet here, sir. If you see, wooden sheet is there. Okay, why it is needed? Unnecessarily they are adding one wooden sheet so that cost is increasing now. Okay, this is not functional. Even if this kind of wooden sheet is not there, so definitely we will purchase this podium. So this sheet is non-functional, this sheet is functional. Okay, or else let look at that AC. So what is the core main function of that AC means cooling. Okay, some cooling condensers will be there in that AC. Okay, that is functional feature. Non-functional features are also there, outside designs on that plastic and all. Okay, now, so if you want to reduce the cost of a product, you should not touch that core functional features. That condensers quality you should not reduce. That plastic, outside plastic is there, na? That plastic quality you can compromise. Non-functional features you can touch. Okay, functional features you should not touch. Okay, if you want to reduce the car price, what is the core function of car means? Engine. Okay, you should not compromise on the quality of engine. Okay, so if you want to reduce the cost of a car, you can do non-functional feature, design models, outside design will be there now. Okay, in that you, so in seating arrangement, seating quality, interior decoration, in those things you can do cost reductions and all. So that's why in car manufacturing, in each model different prices will be there based on the features. Okay, see, if you see XUV 700 model is there, Mahindra. Okay, nearly 10 to 15 models are there, sir, starting from basic model, so ending with extremely luxury models. Okay, so different price ranges will be there. Why different prices means, okay, engine is same, they won't compromise on engine, so they will do some cost reductions in non-functional features. Okay, if you want additional features, additional cost. No additional features means no cost. So like that, so this is, there is some functional engineering, non-functional engineering. So we can use EOQ technique, just-in-time technique. We can use so ABC techniques. So many techniques are there to reduce the cost, sir. Okay, so that means to reduce the cost, we can use all DM and SCM techniques. Okay, now how to calculate this target cost means here. See, in buyer's market, how we are calculating this 60 rupees, sir? Cost is equal to single formula. Cost is equal to selling price minus profit. Okay, in seller's market, what is that form? Selling price is equal to cost plus profit. Okay, here in buyer's market, cost is equal to selling price minus profit. Sorry, you have written same formula, so just by interchanging that one, this one, sir. No. Okay, maybe that looks like a same formula, but two different formulas, sir. Our perception is different. What is that perception difference means? Here in buyer's market, first of all, selling price is fixed by the customers or market. Industry itself fixes the selling price. This we cannot change. Okay, you have to achieve that selling price. So you fix your profit, selling price minus profit is your cost. You have to produce the product with that cost only. Here, okay, already you have incurred that cost. To produce a product, you are not having any restrictions. So freely you have produced a product with some cost. This is already done. Now you add your desired profit, you will get a selling price. But here selling price already fixed. Okay, so you subtract your profit, target cost. Okay, simple, sir. Cost is equal to target selling price minus target profit, that is target cost. Simple formula. This formula is only our target costing. Okay. With this basic introduction, we can solve any problem. Okay. And 1 minute. Okay, now let's do some basic questions on this concept, target costing, sir. Okay, what is target costing means? Target selling price minus target profit, that is target cost. Simple. Okay. So based on the information given in the question, we have to calculate target cost. One question is there on target cost reduction. Okay, that model also we will do. Okay, you guys are having latest updated book 3.1. Okay, okay. If you're not, fine. Yours old version, new version, old version. Okay, fine, sir. So same questions are also there in old version. Okay, otherwise I will share that PDF, questions PDF and the group. Let's start with some basic questions, sir. Basic question. This cannot be asked in the examination for 7 marks, but can be asked for an MCQ. Read this question number 1. ఏమైంది ఏసీ ఆఫ్ చేయాలా then what happened రా గణేష్ okay okay please read this question. Okay, see, a company requires 85 lakhs in sales to meet its target net profit. Okay, so what is this 85 lakhs means? This 85 lakhs is our target sales. Target sales. Okay, to meet its target net profit, its contribution margin is 30%. Fixed cost are 15 lakhs. What is the target net profit? Okay, so as they have given contribution margin and all, we can calculate target net profit. Sales 85 lakhs. Sales 85 lakhs. So contribution margin is 30% means what is the contribution? So 85 lakhs into 30% is 25 lakh 50,000. Okay, so what is the variable cost? 25 means 60. Okay, some 59 something. Okay, Okay, Nama. Now that is variable cost. We don't need that one here. But our contribution is 25 lakh 50,000. Contribution minus fixed cost. What is the fixed cost? 15 lakhs. That means how much profit is 10 lakh 50,000. So what we have done, sir, simple. Sales minus cost, we got profit. Okay, so that cost calculation indirectly through contribution they have given. Okay, now this question, sir. So study material question number 41. That means in old material illustration 41 is there somewhere. Illustration 41 in old material. Uh, so tell that page number, sir. Okay. So in our new version 3.0 book 3.5.2 question number 4 study material question 41 June 25 attempt question, sir. Recent attempt question only. Okay. Now read this question. We shall try to solve this point by point. Okay. Where is notes? Where is pen? So take your rough books, okay, pens, okay, along with me. If I am solving the problem, means along with you also start solving the problem, okay, so that it is the practice in the class itself, okay. Okay, this is not the session like I'm teaching, you are learning, later you practice. That is not like this, like not like that. But what we have to do is like cumulatively, we have to solve one problem. Here itself, we have to learn that problem, okay. So read this one, go through that question once. So just think what they're asking, how can we solve that? How can we answer point A, point B, point C, each one? Yeah, hi, Namachivayam, NS, hi sir, Akshay Kumar, hi, Harsha Chimnani, okay, so voice is low, okay. Manoharan, hi, Kirti Kumaran, Jagan, Ongol Bulls, hi. Okay, am I audible now? Is my voice better? How to identify whether the book is a new version or old version? In old version, version 2.0, in the cover page itself, okay, 2.0 is there, sir. Okay, if that version number 3.0 is not there, means that is version number 3. Okay, this is the template. If in the workbook, at the bottom, if you can identify this 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 image, means that is 3.0. If that kind of image is not there, means that is 2.0. Okay. Okay, new version book out and old version book. So give me the camera. Give me the new version book. I will show it. This is our guys. This is our SCM and DM workbook, new version, version 3.0. Okay, so you can see that image. This cute fellow is me only. Yeah, you can find this kind of book. This is version 3.0. Okay, similar kind of image will be there for concept book as well. Okay. So done. So those who are watching this live class, okay, so please try to solve the problem, practice the problem along with me, sir. Okay, take your pens and papers. Okay, don't just lay on the bed and watch the class, sir. You have to set some environment where you can watch the class peacefully, and so set some environment like so for taking for writing as well. Okay, so practice along with me. Okay. Now see, this June 25 attempt question, that is study material question only, easy question. Okay, directly as it is, that question was asked in June 25 attempt. Cello company has the capacity of production of 80,000 units and presently sells 20,000 units. Their capacity is how much? 80,000. Presently selling 20,000 at 100 rupees each. Okay, the demand is sensitive to selling price, and it has been observed that every reduction of 10 in selling price, demand is doubled. Okay, right now, see, so capacity is 80,000 units. Presently, we are selling 20,000 units at 100 rupees. Demand is selling sensitive to selling price. That means if you reduce the selling price, so price demand relationships are theory of demand. Okay, so if price increases, demand decreases. If price decreases, demand increases. And it has been observed that every reduction in 10 rupees in selling price, demand is doubled. What is the selling price right now? Present selling price is 100. Number of units demand 20,000 units. Okay. So if I reduce the selling price by 10 rupees, that means to if I fix at 90, what is the sales? Doubled. Demand will be doubled. 40,000. No voice. So one more time, if I reduce the selling price by 10 rupees, that means if I fix at 80 rupees, how much demand will be there? 80,000. Okay, so one more time, if I reduce the selling price by 10 rupees, if I fix it at 70, how much units I can sell? 1 lakh 60 we can sell, but our capacity is what? 80,000 only. So that means more than 80,000 we cannot produce now. So to sell maximum quantity 80,000, we can fix selling price at 80, sir. Okay. Now what they're asking, point number 1, what should be the target cost? Target cost at full capacity if profit margin on sale is 25 percentage. Okay, so at full capacity, what is our selling price? Point A. At full capacity, so point A answer at full capacity. At full capacity, full capacity of 80,000, our selling price is 80. Okay. So how to get target cost, sir? Selling price minus profit. What is the profit here? 25 percentage. 25 percentage means on 80 into 25 percentage, 20 rupees. Okay. If I subtract that 20, I will be getting 60. This 60 is what? Target cost. This 60 per unit total. Per unit cost. Okay. So can you tell me the total cost to produce total 80,000 units? Total 80,000 units. Cost of 80,000 units. 48. Okay. Okay. 1 minute. Cost 60 rupees per unit. So total cost 80,000 into 60 rupees, 48 lakhs. Okay, fine. Now done with first point. There are what should be the target cost? Target cost per unit 60 rupees. Total target cost 48 lakhs. That's it. Done with point number A. Next, come to point number B, sir. Point number B, what should be the cost reduction scheme at full capacity if at the present level 40 percentage of cost is variable, total fixed cost is 36 lakhs. Okay, so what is that point? Means if existing cost structure, with the existing cost structure, if I go to 80,000 units production, how much cost it will be, that we need to calculate, sir. Then our target is 48 lakhs 60 rupees, that is our target. Okay, with the existing structure, what is that existing structure? Means 40 percentage of cost is variable cost, 36 lakh is fixed cost. Okay, see, at existing cost structure, existing cost structure, so at existing level, how many units we are selling? 20,000 units. What is the selling price? 100 rupees is selling price. Selling price is 100. What is the profit percentage? 25 percentage, same. Profit 25 percentage. That means how much? 25 rupees. Huh? If I subtract 25 rupees, 75 is cost. What is this cost, sir? Present cost. That 60 is our target cost. Okay, so present cost structure is 75. Okay, in this 75, can you tell me how much is the variable, how much is the fixed? Variable cost 40% means how much? That is equal to 30 rupees. 30 rupees is variable cost. Okay, then remaining 35 is fixed cost. But that fixed cost total was given in the question. Okay, so fixed cost, how many lakhs? 36 lakh. Okay, okay. 36 lakhs. That is in total. Okay, in total only I am taking. Okay, even though if I increase the production, this fixed cost in total will not change. Okay, variable cost per unit will not change generally. Okay, now, so with this cost structure, variable cost per unit 30, fixed cost 36 lakh. If I produce 80,000 units, what will be the cost? Okay, cost of 80,000 units, existing cost structure. So then variable cost 30 rupees into 80,000 plus 36 lakhs, right? Total. Can you tell me how much? 60 lakhs in total. 60 lakhs is what, sir? If existing cost structure, variable cost 30 rupees, fixed cost of 36 lakhs, if I go and produce 80,000 units, I will incur 60 lakhs. But what is our target? Okay, to maintain 25 percentage of profit, I have to produce 80,000 units at 48 lakhs only. Okay, are you getting that point? Our target is 48 lakhs. But if you continue with the existing structure, if you continue, you will incur 60 lakhs. That means how much cost we need to reduce? 12 lakhs. So cost reduction scheme. Target cost reduction. That is equal to 60 lakhs minus 48 lakhs. 12 lakhs is target cost reduction. Okay, done. Okay, now, so third point, sir, easy point. If rate of return desired is 16 percentage, what will be the maximum investment at full capacity? Okay, see, at full capacity, how much profit we will get, sir? Point C. At full capacity. At full capacity, Selling price how much amma? Selling price 80 rupees. Profit 25 percentage means 20 rupees. Okay, how many at full capacity means we are selling 80,000 units, huh? Okay, that means total profit. Can you tell me total profit of 80,000 units? Profit of 80,000 units, 80,000 units into 20, 16 lakhs. 16 lakh is our target profit. Okay, now what they're asking, if rate of return desired is okay 16 percentage, what will be the investment? Okay, so rate of return desired is 16 percentage means what, sir? Return on investment equal to 16 percentage. The 16 percentage, how to understand that 16 percentage, sir? That means 16 percentage means what? 16 divided by 100. 16 divided by 100. Can I write it like this? Okay, what is this 16 divided by 100, sir? If you invest, return on investment means return on investment. This is return, this is on investment. If I invest 100 rupees, I will get 16 rupees return. Okay, at this full capacity, so if I produce 80,000 units, how much return I am getting? 16 lakh. That means the 16 percentage, the 16 percentage return is equal to 16 percentage is return, 100 percentage is investment. Okay, so at full capacity 80,000 units, I will be getting 16 lakhs as return. Then how much investment I need? Okay, the profit we are getting 16 lakhs is equal to return of 16 percentage. Then 100% investment we have to make now. What is that investment? 16 percentage 6 lakh means cross multiplication, 100 percentage 100 lakhs. 100 lakhs. That means we need how much investment? 100 lakhs investment. Okay, so two important questions are there, sir. Total three questions are there. First of all, let's discuss the three questions first. Okay, this question number 4 and this study matter question number 6, study material question number 43. Study material question number 45, easy question only, question number 7. And then, okay, question number 8, study material question number 46. Okay, see, past attempt questions or MQP questions. Read this question number 6, study material question number 46, December 2022 attempt question. Just read this question once. We will discuss this one and we shall try to solve, sir. Remaining 3 questions, each and every question we shall try to practice in the class itself. Okay. Yeah, hi, mastering minds. Because so is my voice audible now? Done. See, question number 6, study material question number 43. ABC Enterprises has prepared a draft budget for one of its product for next year as follows. Quantity 10,000 units. Selling price per unit 300 rupees. Variable cost direct materials 80 rupee. Uh, direct labor 2 hours into 30. So direct labor hours needed to produce a product is 2 hours into 30 rupees per hour, 60 rupees labor cost. Variable overheads 2 hours into 5, okay, 10. So how to understand this variable overhead 2 hours, sir? That means we have to assume like this is 2 hours, this is 2 hours. That means variable overheads are being absorbed based on labor hours. Okay, so if labor works for 2 hours, per hour labor cost rate is 30 rupees, and variable overhead is 5 rupees per hour. Total labor plus variable cost, labor cost plus variable overhead cost, we call that as conversion cost. Okay, so if raw materials are sent to the factory, in the factory labor will work, we will incur some overhead, so to convert the raw material to finished goods. So that's why the cost we incur in the factory, labor cost and variable overhead cost, is called as conversion cost. Okay. See, here in this variable overheads are also being absorbed based on labor hours. Okay, if labor worked for 1 hour, 30 plus 5 rupees is the cost. 2 hours, 2 into 35, that is equal to 70. That means total conversion cost is 70. Okay, that is the first point we need to understand. Second one, contribution per unit 150, budgeted contribution 1 lakh, 15 lakhs, budgeted fixed cost 14 lakhs, budgeted profit 1 lakh. Okay, they have prepared some budget, sir. In that budget, they have they made some budget like to get profit of 1 lakh rupees. The board of directors is dissatisfied with this budget and ask working party to come up with alternative budget, higher profit, higher target figures. Okay, they are not satisfying with current 1 lakh rupees profit, they want more profit. Okay, the working party reports back with the following suggestions, which that will lead to budgeted profit of 2 lakh 50,000. So they have done some rework, sir. In that rework, what they got is like they have shown 2,50,000 revised budgeted profit. Okay, now the company should spend 2,46,000 on advertisement. Okay, so this 2,46,000 advertisement cost means fixed cost or variable cost, sir? Fixed cost. Huh? Now already we have fixed cost 14 lakh plus 2,46,000. Total 16,46,000 is total fixed cost. Then on advertisement, and set the target sales price up 316.75. Already what is our current selling price? 300. We are changing it to 316.75. Okay. So it is expected that sales volume will also rise in spite of rising in selling prices. Okay. So if our selling price increases, generally as per theory of demand should decrease, right? But here we are increasing the selling price to 300 to 316. But they are saying like, okay, as we are spending on advertisement promotions, this 10,000 units also will increase to 12,000 units. Okay, next one. In order to achieve extra production capacity, okay, presently they are producing 10,000 units, but we need to produce 12,000. To achieve that extra production capacity, however, workforce must able to reduce the time taken to make each one of the unit of product. If labor could effectively work, they can reduce the time taken per unit. What is the time taken per unit right now? Time, 2 hours. 2 hours. 2 hours. 2 hours is labor time per unit, sir. Okay, currently they are taking labor time 2 hours, but if they work efficiently, they could reduce from 2 hours to something. They can reduce now. Okay, the proposed offer, it is proposed to offer a pay and productivity deal in which the wage rate per hour is increased to 40 and hourly rate of variable overhead will be unaffected. That means previously labor rate is 30 rupees. So now it is increased to 40. That means what is the total conversion cost per unit? 40 plus 5. 45 is the conversion cost into number of hours. We will get conversion cost. Okay, number of hours. We don't know how many hours it will take. So currently 2 hours, but if they increase their efficiency, they have to reduce the per unit time. So how much time they will take in the future, I don't know. That's why I'm writing it as X into 45. I will get a conversion cost. Okay, now ascertain the target labor time required to achieve the target profit. We need to calculate so target labor time required. That means this unknown X is we have assumed something. This X we need to calculate. What is that X? Labor time to produce a product. Okay. So to calculate this X, I need this total value. X into 45 will get a conversion cost per unit. Now, if I know this conversion cost per unit, I can calculate that X. But how to calculate that conversion cost per unit? Previously it is 70. But now previously means previous selling price, previous fixed cost. So all these variable cost we got 70. But now with the revised information, we can also calculate this missing figure. Na? Okay, that missing figure is nothing but, so take this sales value, take this material cost, okay, take this fixed cost, take this budgeted profit of 2,50,000 and calculate missing figure conversion cost we can calculate, sir. With that missing figure, we can calculate X value. Okay, getting that point? So in this question, our target is to calculate new labor time. Okay, already previous labor time is 2 hours. At that time, per hour cost is total labor cost plus conversion cost is 35. Previously 70 is per unit cost, but now we are paying, instead of 35 we are paying 45 per hour. Number of hours we don't know, they are reducing the hours. Okay, so that means if I calculate this total value, I will get this X value. For that we need to use this information. By using this information, calculate the missing conversion cost value. Okay, so let's do this question. While doing this question, you will get some clarity. See, take side heading in SFM or SCM or DD, whatever the subject it is. Whenever you are calculating something, for that something, keep side heading. Okay, so what we are going to calculate here, calculation of conversion cost per unit to achieve target profit ₹2,50,000. Okay, so let's take two columns, particulars, rupees, okay, another rupees, total column, per unit column. I'm taking two columns. Okay, so general income statement, sir. Normal income statement. So how to write that income statement? Okay, first one, sales. Okay, volume is 12,000 units. Sales per unit, sales how much? Sorry, selling price per unit 316.46 75, sorry, 316.75. Okay, from the sales we have to subtract variable cost, right? Variable cost. Okay, so if you subtract variable cost, you will get contribution. What is the variable cost here? First one, material cost. What is the material cost? Okay, so material cost, no change. They haven't given any information, that's why no change in material cost. Okay, so next variable cost is labor cost and variable overhead cost. That means conversion cost I am writing, sir. Conversion cost. Conversion cost. So do we know how much it is? Okay, so some hours, number of hours into 45 we know, but we don't know the number of hours, no? If that is 2 hours, 2 into 45, 90. But so labor is reducing the time. We don't know how many hours. Okay, so leave it like that. Next, so if I subtract that sales minus variable cost, I will get what? Contribution. Okay, so contribution. So contribution minus okay, contribution into number of units, we will get total contribution. From the total contribution, subtract fixed cost. Fixed cost. Fixed cost how much? 14 lakhs already existing. Additional advertisement cost is there, 2,46,000. So write it in total column. 16 lakh 46,000. Write it in total column. That is total. No? Total that you will incur for 12,000 units. From that contribution, if you subtract this fixed cost, you will get profit. Profit. Our target profit how much, sir? 2,50,000. Okay, so are you okay with this format? Just some format only, sir. So I have written some marginal cost and income statement. I have presented the information which I know. Now let's calculate missing figures. Okay. Can you tell me the total contribution here? Okay, total contribution means what, sir? Already we know fixed cost, profit. We know contribution is equal to fixed cost plus profit. Na? Okay. 18,96,000. So if total contribution is 18,96,000, so number of units is 12,000 units. Can you tell me the per unit contribution? Nice. 158 is okay. So contribution. Okay. Now, so sales minus total variable cost, you will get contribution. Okay. So what is missing figure here? So sales, selling price 316.75 minus margin material cost minus conversion cost, you are getting 158 means. Can you tell me what is that conversion cost? 78.75. This is what, sir? Balancing figure. Okay, are you okay with this calculation? 78.75. Are you getting that 78.75? So how, sir? 316.75 minus 80. Okay, then that amount, so also subtract contribution 158. You will get 78.75. Okay, that 78.75 is balancing figure. That is our target. Okay, now, so if you want to get a profit of 2,50,000, what should be our conversion cost per unit? 78.75. Okay, so how to calculate that conversion cost? So see our target conversion cost. $78.75. How to get that 78.75 means? So generally conversion cost, number of hours into hourly cost. Number of hours, do we know the number of hours? No, I am assuming that as X into, so per hour cost, 45 rupees. How 45, sir? Labor rate 40 rupees per hour, variable overhead 5. That is equal to 78.75. If I know the number of hours into 45, I should get how much? 78.75. Now can we calculate X value? 1.75 hours. Hours. 1.75 hours means 0.75 hours means how many minutes? 1 hour means 60 minutes. 0.75 hours means how many minutes? 60 into 0.75. Yeah. 0.25 hours you have to reduce. 0.25 hours means quarter hour. Quarter hour means 15 minutes. Are you getting that point? Okay. So our target hours. Target time 1.75 hours. Okay. Previous time 2 hours. Okay. Target reduction in time. that is equal to 0.25 hours. 0.25 hours means not 25 minutes. Okay, that is 15 minutes, right? Okay, that is only I'm asking. Done? Any doubts? Okay. Next one, sir. Next, one more important question. Two more questions are there. Okay. This question number 7, sir. Study material question 45. Okay, look at this question. Nothing is there. If you know the format, so just rewriting the information. Okay, read that question. Go through that question once. Nothing is there. Simple question, but that question was asked for 2 times. Okay, a manufacturing company B sells its product at 1000 rupees per unit. Due to competition, its competitors are likely to reduce price by 15 percentage. Okay, that means what is the selling price of their competitors? 1000 minus 15 percentage. How much, Amma? 850 is whose price? Competitor's price. Okay. B wants to respond aggressively by cutting price by 20 percentage. Okay, now our company wants to reduce the selling price by 20 percentage. Means 800. Okay, so our selling price is how much now? 800. expects that present volume of 1,50,000 units per annum will increase to 2 lakh. So if I reduce the selling price from 1,000 to 800, sales will increase from 150 to 2 lakh. Okay, so B wants to earn 10% of net profit on sales. See, 1000 minus 20 percentage, that is our selling price 800. In that 800, what is our target profit? This is 800 is our target selling price, sir. Minus target profit. How much? 10 percentage. 10 percentage means 80. 800 minus 80. 720 is what? Target cost. Okay. Based on the detailed value engineering, so B wants to, based on the detailed value engineering, the comparative position is given below existing target. Okay, now see, direct material cost per unit, existing, not needed, target. Look at the target, sir. 385 material cost, labor cost per unit 50. So take your calculators, calculate 385 plus 50 plus direct machine cost per unit 60 plus that's it, 495. 495 is so direct manufacturing cost. Okay, our target is 720. Out of that, 495 is manufacturing cost. Remaining cost, manufacturing overheads, number of orders. Number of orders. This is number of orders. 21,250 is the number of orders. Okay, per order cost is 80. That means total ordering cost is how much? This is number of orders. 21,250 is number of orders. 17 lakhs. 17 lakhs is total ordering cost. Okay. Now I have to recover this 17 lakhs from how many units? 2 lakh units. Yes. If I reduce the selling price, 2 lakh is our sales now. Okay. 17 lakhs divided by 2 lakhs. Can you tell me how much? 8.5 rupees per unit. Okay. That is what ordering cost per unit. Testing hours. 2 rupees per hour. Hours are how many hours? 30 lakh hours. Number of hours 30 lakh hours into 2. That means 60 lakh. 60 lakh divided by 2 lakh units. Per unit testing cost is 30 rupees. Okay. Units reworked 100 per unit, 13,000. 13,000 units are defective units. On that units they are working. So this is somewhat like cost of quality. So 13,000 into 1 lakh. Sorry, 100 rupees. 13 lakh divided by 2 lakhs. How much? 6.5. Okay. So what is the total till now? 540. Yeah? Okay. So remaining some other cost is there, sir. Manufacturing overheads are allocated using relevant cost drivers. Okay. So relevant cost drivers means manufacturing overheads. This is manufacturing overheads, na? This we are allocating using a number of units basis. Other operating costs are there, sir, per unit. These operating costs are per unit cost. Okay, expected volume are expected for. Sir, research and design. 50 rupees cost per unit. Add this 50 rupees. Okay, marketing and customer service 130. Also add this 130. Now, what is the total cost? 720. Our total target is 720. Out of the target, 495 is manufacturing cost. This 8.5, 36.5 is manufacturing overhead cost that we have absorbed per unit based on number of units. Remaining, this was given in the question. If you add that, total 720. Now, required, calculate target cost per unit. How much target cost per unit? 720. And target cost for the proposed volume. That means we need to maintain two columns. Per unit column, total 2 lakh units column. Break of different elements. Different elements, cost elements means what? Given elements only. Variable cost, direct material cost, labor cost, machine cost. Okay. Next, manufacturing overhead, number, ordering cost per order, testing hours, testing cost per unit, sorry. Ordering cost per unit, testing cost per unit, revoked cost per unit. Next, this research cost per unit, marketing cost per unit will get 720. Prepare target product profitability statement. Okay, we know selling price 800, so cost 720, profit 80 rupees, so per unit and totals. Okay, now come to the solution. Okay, we don't need to solve this one. This is bacha question only. Bacha means easy question. Okay, calculation of target cost per unit, target cost per proposed volume. Target cost per unit 800. How 800 means 1000 less 20%. Target margin 10%, 80. Target cost 720 per unit. Okay, element wise breakup of 720 cost. This is per unit column. Per unit column, 2 lakh units column. Okay, we can also write selling price at the top itself. Okay, leave it. Sales, first one sales, sir. Per unit selling price 800. Total 2 lakh sales is 16 crores. What is that number, sir? 16 crores. Okay, so cost of goods sold, direct material 385, there in the question. Direct labor 50 in the question. Machine cost 60 given in the question. Next one, manufacturing overheads, ordering cost and ordering cost per unit 8.5. We have done that calculation. Testing and inspection cost per unit 30. Rework cost 6.50. Done that calculation. Other operating cost given in the question 50, 130. Total 720. Profit 80. Okay, are you okay with this per unit column? Okay, now how to write that total column, sir? Multiply each element with number of units, you will get the total column. That's it. For this bacha question, simple question, they are giving 7 marks. That was asked for 2 times, sir. December 23, June 2017. In 1 or 2 MQPs also they have given, sir, this question only. Okay. Now next important question is question number 8, sir. Study material question number 46. Okay, read this question once. Go through that question. Done. Okay. See, this is the question based on target cost reduction. Okay. So first of all, S Limited has sales of 2 lakh units at a price of 100 per unit and a profit of 70 lakhs. Current sales is 2 lakh units, price 100 rupees. That means total sales value, how much? 2 lakhs into 100 rupees means 2 crores. Yes, 2 crores. Uh, and a profit of 70 lakhs in the current year. Okay. Due to stiff competition, next year company has to reduce its price of product at the rate 3% to achieve the same target volume of sales. Okay. Next year they are reducing the selling price. By how much? 3%. Okay. So if I reduce the selling price, total sales value will get reduced. Na? Okay. What is the sales value currently? Okay. See, 2 crores is current sales value. 2 crores, write it aside. 2 crore. Now I am reducing selling price by 3% means total sales value will be reduced by 3%. That means how much sales value will be reduced, sir? 3% means 6 lakhs. 2 crores into 3%. 1 crore 3 lakhs, 1 crore 3 lakhs, 6 lakhs is the sales value will be reduced. If sales value get reduced by 6 lakh, if we have same cost level, our profit will get reduced. Na? See, so if sales are getting reduced, your cost is same, your profits will be declined. Okay. So if you want to get same level of profit as previous, if you want to get same level of profit as our sales reduced, do we need to reduce the cost or not? Yes. Sales are getting reduced by 6 lakhs. If you want to get same level of profit, you have to reduce the cost by 6 lakh. Okay. Now what is our target cost reduction? 6 lakhs. Simple. Okay, the cost structure and profit of current is as given below. Direct materials. Current structure, cost structure is like this. Direct materials 50, direct wages 40, variable factor overheads 15, fixed overheads including sales and administration 25. Total cost is 130. To achieve the to achieve the target cost to maintain the same profit. This is the line, sir. Underline that point. To achieve the target cost to maintain the same profit. If you want to achieve the same level of profit, you have to reduce the cost by how much? 6 lakhs. Are you okay with that 6 lakhs? Okay. Company is evaluating proposal to reduce the cost. Okay, now our target is to reduce the cost by 6 lakhs. Now how to reduce that cost? That information and all they are giving in the question. Okay, reduce labor cost and fixed factory overheads. A vendor supplying the machine suitable for the company operations has offered the advanced technology semi-automatic machine of 10 lakhs as replacement of okay. Now to reduce 6 lakhs, we are purchasing a machine, sir. That machine cost 10 lakhs, okay, as a replacement of old machine worth 3 lakhs. Okay, we have a machine, old machine, that cost is worth is 3 lakhs. Okay, now the vendor is agreeable to take back the old machine for 1 lakh only. Okay, see. New machine cost 10 lakhs, sir, as a replacement of old machine, but there he is taking it 1 lakh only. So that means 10 lakhs new machine cost. We are giving 1 lakh machine, old machine. That means how much we need to pay? 9 lakhs we need to pay. That is the clarity we need. Next one, the vendor is agreeable to 1 lakh. The company policy is to charge depreciation at 15% on WDV, written down value. So now how much is our machine value means 10 lakhs, right? On 10 lakhs we need to write depreciation. The maintenance charge of existing machine is 1 lakh per annum. Okay, currently we have one machine, old machine. For that annually we are incurring 1 lakh rupees maintenance cost. But what will happen? Whereas there will be warranty services free of cost for new machine for first 2 years. Okay, currently we are incurring 1 lakh rupees maintenance cost for existing machine. But if you purchase that new machine, you won't incur that maintenance cost for 2 years. There are 7 supervisors whose salary is 1.5 lakhs per annum. The machine is having conveyor belt is expected to help the cost cutting measures in the following ways. Improve productivity by of workers by 10%. This is the point, sir. If labor productivity is getting increased, labor time will get reduced or increase. So time taken to produce a product per labor will reduce as their productivity is increasing. Okay. See. So that means if labor time is getting reduced, means labor cost will reduce, right? Okay. What is the current labor cost? 40. Okay. So let us assume currently labor productivity is 100%. That is increased by 10% means productivity is increasing to 110%. Let us assume. Okay, currently 100, that is getting increased to 110. So at 100%, previously what is the labor cost? 40 lakhs. 40 lakhs. If labor productivity is increasing, okay, so labor cost will reduce, right? Okay. So to get new labor cost, what ratio I have to apply, sir? Either 110 by 100 or else 100 by 110. These two ratios, which one I have to apply? 100 by 110. Why? So if productivity is increasing, labor cost should reduce, right? So that's where apply reverse ratio. 100 by 110. Generally, what we think is like, okay, at 100%, 40 lakhs is the cost. So what would be the cost if 110? So if you apply that ratio, cost will increase. Okay, so if productivity is getting increased, cost will reduce, right? So that's why you have to apply reverse ratio. So apply, sir. 36.36, 36.36. Okay, previously labor cost is 40. Now the labor cost is 36.36. How much we can reduce? 3.64. 3.64 lakhs is getting reduced. Our target is 6 lakhs. Here we are reducing 3.64 lakhs. Second point, cut down material wastage by 5%. Previously material cost how much? 50 lakhs. Okay, minus into 5%. 5% waste we are saving. That is cost saving only now. 50 lakhs into 5%. 2.5 lakhs. Okay, so third point, elimination of services of supervisors because of services supervisors we can eliminate. How many service supervisors we can eliminate? We don't know now. Okay, so our target 6 lakh. We apply all other cost reduction schemes. Okay, for the remaining deficit, we can remove supervisors. Saving packaging cost by 1 lakh. Savings, cost saving. Assume cost of capital be 15%. How many supervisors should be removed? Okay. How many supervisors should be removed is the question, sir. So in the question, our target is 6 lakh cost reduction. In that cost reduction, they have given some scheme. What is that scheme means? They will install a new machine in place of old machine. Due to that installation of new machine, we will incur some cost as well as some benefit. Benefit means what, sir? Benefit is cost reduction is our benefit. Additional cost means, what is that additional cost means? Depreciation cost. Okay, additional depreciation cost. And also they have given some capital cost. That means opportunity cost we incur. Benefits, what are the benefits means? So maintenance cost can be reduced, labor cost can be reduced, waste can be saved. Okay, here packing cost 1 lakh rupees can be saved. Okay, we write the benefits one side, cost one side. Okay, so let's say our benefits are 5 lakhs, sir. Cost are 2 lakhs. That means in net we can reduce 3 lakhs, right? For example, only I'm telling 3 lakhs we can reduce net savings. Okay, our target is 6 lakhs. Net saving by machine we can save 3 lakhs. For remaining, whom we can remove means supervisors. For remaining 3 lakhs, 3 lakhs rupees, how many supervisors we can remove means one supervisor salary is 1.5 lakhs. If you remove two supervisors, enough. Okay, that is the process. But here randomly I told you benefit 5 lakhs, cost 2 lakhs. But reality, that information was given now. Let's calculate that one. Let's calculate. Okay, are you okay with this 6 lakhs, sir? 6 lakhs. What is our 6 lakh target cost reduction? How I got that 6 lakhs means current sales 2 lakh units into 100 rupees, that is 2 crores. Okay, sales getting reduced by 3%. Cost will also reduce by, okay, if sales reduced by 3%, to maintain the same level of profit, we have to reduce the cost by 6 lakhs. That is target cost reduction. Simple line. Look at that point. Target cost reduction. Target price reduction is 3% of 200 lakhs. That is 6 lakh. Okay, target cost reduction is 6 lakh. Target price reduction. Write it like sales reduction. Sales reduction. Current sales is 2 lakhs. How, sir? 2 lakh, 200 lakhs. 2 lakh into 100. 200 lakhs. That means 2 crores. Okay, into 3%, 6 lakh sales are getting reduced. Then that means to maintain same level of profit, our target cost reduction is 6 lakh. Okay, first point. Next one. To get this net savings of, sorry, our target 6 lakhs, no? For that 6 lakhs, they have given some scheme. For the target 6 lakhs cost reduction, they have given some scheme, sir. Okay, in that scheme, let's write all the benefits and cost. Okay, roughly write, sir. Point 1, target cost reduction 6 lakhs. For that 6 lakhs, okay, we need to calculate net savings from machine. One side write benefits, one side write additional cost. Okay, once again read question point by point and tell me whether that is benefit or cost. Okay, so first one, we are purchasing advanced semi technology machine of 10 lakhs, sir, as a replacement of old machine. Okay, old machine worth 3 lakhs, but the vendor is taking it for 1 lakh only. That means what is the difference? 2 lakhs. Benefit or loss? Loss. Loss means, so assume it as a cost. Cost side. Cost side. Loss on old machine. 2 lakhs. How 2 lakhs, sir? 3 lakhs worth minus 1 lakh. Okay. Next one. Again, go to that question. Company policy is to charge depreciation 15% on WDV. So can you tell me the WDV value? Right now, new machine value 10 lakhs. Okay, so already old machine is there, 3 lakhs worth. Okay, existing machine WDV is 3 lakhs. Okay, we have replaced that machine for 10 lakh new machine. Okay. Now, on new machine on 10 lakhs, we have to charge depreciation. So, net value is incremental depreciation. Okay, so you purchased a new machine. On new machine, how much depreciation we will charge means 15%. 10 lakh into what is the value of new machine? Depreciable value of new machine is 10 lakhs. Into 15%, we charge the depreciation. But already, so old machine, we have been incurring some depreciation cost. Existing machine depreciation 15% only we have to incur. But just because of replacement, we are incurring on depreciation on 10 lakhs. The difference is there, that is called incremental depreciation. That incremental depreciation only our cost. Okay, so what is our incremental cost here means, just because of this decision, how much additional cost we are incurring. If you are not replacing that machine, on 3 lakhs only you would have incurred the depreciation. But because of replacement, new machine cost 10 lakhs. On 10 lakhs, now we are incurring depreciation. What is the additional depreciation we need to calculate? Additional incremental depreciation. Incremental depreciation 10 lakhs minus 3 lakhs into 15%. How much, Amma? 1,05,000, 1.05 lakhs. Are you okay with this point? Gen 9 lakhs. Okay, okay, we are paying. So this is somewhat like you are purchasing new machine. New machine worth is 10 lakhs. For the 10 lakhs, I am giving 9 lakh cash, 1 lakh machine. Total consideration I am paying how much? 9 lakh cash, 1 lakh machine. Total 10 lakhs I am paying. Now the value, depreciable value of new machine is 10 lakhs. Generally, I will depreciate, so I will calculate depreciation at 10 lakhs only. Okay, that is the depreciation. But so just because of the decision, how much additional cost we are incurring? Additionally, we are incurring. So you have already 3 lakh machine. On this 3 lakh machine, you have been charging depreciation. If you are not, if you haven't replaced the machine, on 3 lakhs, you might have calculated the depreciation. But additionally, just because of this 10 lakh machine, additional cost you are incurring, na? That additional depreciation only we need to consider for decision making point. Are you getting this point? Okay. Okay. So we are considering only incremental depreciation. This is not the total depreciation. Okay. So next point. Next one. The maintenance charge of existing machine 1 lakh per annum. Whereas warranty is there for new machine. That 1 lakh is what, sir? Cost of benefit? Benefit? Okay. Benefit side. Maintenance cost 1 lakh rupees. Savings in maintenance cost. Savings in maintenance cost. Savings in maintenance cost 1 lakh rupees. Okay. This 2 lakhs loss on old machine 2 lakhs. Okay, na? Okay. So 1.05 depreciation, incremental depreciation. Okay, na? Now savings on maintenance 1 lakh. Okay, na? Now what all the other points are there? So 7 supervisors. We don't know how many to remove, that we will discuss. First one, improve productivity by workers. So how much we can save? 3.64 lakhs. Okay, now let's do that calculation. Savings in labor cost. Labor cost 40 lakhs originally minus 40 lakhs into 100 by 110. So originally we are incurring, so previously we have incurred 40 lakhs, but now you won't incur that much as productivity is increasing. So you're incurring 36.36 only. That means 3.64 lakhs is our savings. Okay. So savings on waste, material cost savings. Material cost savings 50 lakhs into 5 percentage. 5 percentage. 2 lakh. That means 2.5 lakhs. Packing cost saving. Packing 1 lakh. Maintenance cost. Maintenance cost written 1 lakh. Okay, what are the other cost? See. Elimination of service, saving in packing cost. Okay. So assuming cost of capital is there, sir. Okay. So I have purchased 10 lakh worth machinery. If I haven't purchased that machine, okay, the 10 lakh worth value. What is the 10 lakh means? 9 lakh cash, 1 lakh worth of old machine. Total 10 lakh. If I have invested the total 10 lakh in outside interest, so if I have invested that one in given for bank interest, or else if I have done something other means, I would have got how much interest? 15% return. I might have got that. Okay, just because of purchasing that machine, I am losing that one. No? Opportunity cost 15% on 10 lakhs. This is cost we have to take. Opportunity cost. Okay, 10 lakhs into 15%, 1 lakh 50,000, 1.5 lakhs. Okay, so can you calculate this total benefits? 8,14,000. What is the additional cost? 4,55,000. So what is the difference? 3,59,000, 3.59 lakhs net savings. Net savings 3.59 lakhs. The same calculation is also there in our workbook. Don't worry. Okay. Our target is to save how much cost? 6 lakh. Here through installation of new machine, we are able to save how much? 3.59. The deficit we need to save how much? Deficit cost saving 6 lakh minus 3.59 lakhs. How much amma? 2.41 lakhs we have to save. For this deficit 2.41 lakhs, whom I can remove? Supervisors. Okay, one supervisor salary is 1.5. Okay, to save 2.41 lakhs, how many supervisors I need to remove? Number of supervisors to be removed. That is equal to 2.41 lakhs is our target. One supervisor salary is 1.5 lakh. That means 1.6 supervisors. I cannot remove 0.6 supervisor. No? So that's why we need to remove 2 supervisors. Deficit means okay, so our target cost saving is 6 lakh. Our target is 6 lakhs. Target to save 6 lakhs. But we are, so through installation of new machine, we are able to save 3.59 lakhs. Additional cost, even more, surplus or deficit, whatever it is. We need to save even more. So 2.41 lakhs, I need to cut down the cost. No? Are you getting that point? See, our target cost reduction is 6 lakhs. Just by installation of new machine we are able to save how much? 3.59 only. That means 6 lakh our target, 3.59 through installation of new machine we are saving. Remaining amount 2.41 lakhs, that is we are calling it as deficit in cost saving. Okay, for that 2.41 lakh I need to remove supervisors. Okay, so how many supervisors means 2 to 1.6, like that we should not write. Why means 0.6 supervisors we cannot remove. Done? Any doubts? Okay, now go to this workbook. Question number 4. So at the beginning we have this kind of table is there, sir. At the beginning of the chapter, at the top of the chapter. So mark those questions which we have done. SM study material question 41, or else question number 4 we have done. Question number 4. Oh. Question number 6. Question number 7. Question number 8. Question number 6, 7, 8. 6, 7, 8. Question number 4 we have done. Okay, and also along with these questions 3 and 5 also. 3, 5. So later you shall try to practice this third question, fifth question. These 5 questions are enough, sir. Okay. Okay, old material means in that old material, yes, even 40, 41, 42, 43, 44. Okay, in old material. New material, that is question number 3, 4, 5, 6, 7, 8. How many questions? 6 questions, huh? Yes, okay, fine. We done 4 questions. Remaining 2 questions also you try. If you get any doubts means I will explain. Okay. So thank you all guys. Let's take a break. We'll meet you again at 2 o'clock. Then we will start transfer pricing. Okay. So if we complete the transfer pricing means product life cycle, asset life cycle, probability. Okay. Half an hour, half an hour, half an hour. Maximum 1.5 hour or else 2 hours. 3 chapters. Very, very small chapters. Okay. So this live will be continued like this only. Okay. So we'll meet you at 2 o'clock guys. Thank you. Thank you all. Yeah, hi guys, welcome back. So our next target is transfer pricing. Transfer pricing. See, this handwritten notes I have shared in the group, sir. Okay, so that's why you don't need to write, so that we can so quickly revise these concepts. Then we can directly go to the problems. Okay. See, our next target is question number 3A, sir. 3A, transfer pricing. If you see any attempt, for any attempt, they have been asking this transfer pricing question only for 3A. So 3B, we have discussed target costing, remaining asset life cycle, product life cycle, probability in decision making. 3 chapters are there, small chapters only. For each chapter, 1 or 2 questions are there. Okay, now coming to transfer pricing. See, as a top level management, we have already discussed top level management will take some decisions. They will direct lower level management to implement those decisions. Okay, implementation part will be done by, so implementation part will be done by middle level managers or else lower level managers. Decisions will be taken by top level. Okay, as the decisions are being implemented by lower level management, top level management has to control the persons who are executing the decisions. For that controlling purpose, we have two techniques: standard costing and transfer pricing. Okay, so coming to transfer pricing, sir. In transfer pricing, so normally a company can be organized into two types of structures, organization structures: centralized structure, decentralized structure. Sir, what is centralized structure means? So top level management will be there. Okay, CEO. Okay, board of directors will be there, sir. Okay, all the functions in an organization will be governed by this board of directors or top level management team only. Okay, so if the company is getting profits, okay, as a team, board of directors are running or executing all the operations in the organization. They only so managing entire operations. Okay, if the company is getting profits, so all the managers in the board of directors or else whatever top level management team, so if they are getting profits, everyone wants to take credit. Okay, just because of me only company is getting profits. If I am not there means company is nothing, like that they will be having some feelings, sir. Okay, so if company is getting losses, no one will take responsibility. Okay, so this person, this particular wrong is on my part. That's why only company is getting losses. That likewise, no one will accept any mistakes or else their flaws. No one will accept. No one will take the responsibility. Okay, so to take to assign some responsibility to managers, here decentralized structure came into picture. So what is the problem here is like, when company is getting profits, everyone wants to take credit. When company is getting losses, no one will take the responsibility in case of centralized structure. So now coming to the decentralized structure, so top level management will be there. So they will be dividing the organization into different divisions. So this divisions classification can be done based on different basis or functional basis. Divisions can be divided. Okay, geographical area basis, product basis, process basis, service basis, different basis. We can divide the organization into different divisions. Okay, division A, division B, division C, division D. Okay, now so for each division we assign one manager, divisional manager. Okay, so now responsibility point of view, these divisions are classified into four types: responsibility centers. Four responsibility centers. Okay, four responsibility centers are: first one, cost center. A division can be treated as a cost center, or else the same division can be treated as a revenue center, or else it can be treated as a profit center, investment center. Four types of centers. So first one is cost center. So if a division is being treated as cost center means, okay, so for the division one manager will be there, cost center manager. So this manager will have some powers and some responsibilities. What kind of powers this manager will have means, he is having authority or power to incur cost. Cost center manager, cost center manager will have some power to incur the cost. Okay, so his responsibility will be fixed by setting some target cost. Okay, now top level management will give the manager of cost center one target, like in your division you have to incur this much cost only. That is the target they will be giving at the beginning of the period. At the end of the period they will get actuals. We compare target cost actual, standard actual, so calculate the variance, why this variance difference occurred. Okay, so if there that variance is positive means okay incentives, negative means no incentives. Okay, revenue center. So for revenue center also there will be one manager. That manager is having again some powers, some responsibilities. What is that power means? He can collect the revenue, he can take the decisions to increase the revenue. Okay, to increase the revenue, whatever the decisions you want to take, so he can take the decisions. Okay, so but what is his responsibility? His responsibility will be fixed by setting some target revenue. Okay, so that revenue center manager has to generate so some certain level of 10 crores or 20 crores, whatever the some number will be fixed, that much of revenue he has to generate. If he is able to achieve the target means fine. If he is not able to achieve the target means okay, so no incentives. Okay, cost center, revenue center, next one profit center, sir. So for profit center also there will be manager. So he can, what is the powers he is having? He can incur the cost, he can collect the revenue. Revenue minus cost is profit. That means to get the profit, profit center manager, so he can generate the revenue, he can take the decisions to generate revenue, he can take the decisions to incur the cost. Okay, but his ultimate target will be fixed, his responsibility will be fixed by target profit. Okay, so again top level management will fix some target profit to this target profit center. So let's say for example we are fixing some 10 crores of target profit to this division. Okay, if manager, so whatever the decision he is taking, so he can take the decision to increase the revenue or else to reduce the cost. Ultimate target is to get 10 crores profit. He is getting that, generating that profit means fine. Not able to generate means okay, he is not achieving his responsibilities. Next one, investment center. So investment center means here for that investment, if a division is being treated as an investment center means top level management will allocate some investment to this particular center, sir. Okay, let's say for example some 100 crores of investment will be given to that manager. Okay, with that investment, whatever you want to do, whatever the decisions you want to do, so whatever the assets you want to purchase, you can invest as your wish. But so this manager performance will be so evaluated by based on percentage of return on investment. Okay, so we are giving some 100 crores to this particular department investment as an investment. Okay, he can, that manager can use whatever the way you want to use that 100 crores. But at the end of the period what he has to get means, let's say we are fixing some 10 percentage ROI, means 100 crores into 10 percentage, 10 crores is his target return on investment. Okay, if he is achieving that 10 percentage ROI at the end of the period means fine, not means not fine. That's it. Simple. Four departments, four divisions, four types of divisions: cost, revenue, profit, so investment center. Okay, so each manager will have some responsibilities. They always try to achieve their own responsibilities. Okay. Say, let's say for example coming to transfer pricing, we are taking an example. Manufacturing company is there, sir. One manufacturing company is there, so let's say that is a beer manufacturing company. Okay, so beer manufacturing company, so let us assume two divisions are there. Two divisions are there. What is that? First division means so for bottle, beer bottle, glass bottle is needed. Another one is liquid beer manufacturing. Two divisions. Okay, one division manufactures glass bottle, another division manufactures liquid beer. So they will manufacture that liquid and they will fill that liquid in that glass bottle. They will sell it in the external market. Okay, division A. So division, this glass bottle manufacturing division has to produce glass bottles and they have to send it to the liquid department. They will fill the liquid and sell it in the external market. This is the example, sir. Now let's say for example two departments are being treated as profit centers. profit centers. Okay, if this department is being treated as a profit center, this is also being treated as a profit center. Okay, so both the departmental managers will always try to get maximum profit. Why, sir? Why means their performance will be evaluated based on profits. Okay, now, so he is manufacturing a bottle and he is transferring to the liquid department. But what is actually happening means, okay, so this bottle manufacturing division incurring some cost. By transferring, they are not getting any revenue. Okay, they are only incurring cost. Okay, no revenue. That means they will always get losses only. Okay, but this department manager performance is being evaluated based on profit. Okay, so to calculate this profit, so we have to assign some notional price to this particular department transfer, sir. Okay, we are, so here see what is happening, sir. Let's say for example 50 rupees is the glass bottle. To manufacture that glass bottle, they are incurring 50 rupees cost. But if they are transferring, they are not getting any revenue, no. Okay, so without revenue, they are incurring only cost, losses, performance. How can we evaluate? For that, to evaluate this manager performance, so this transfer is assigned with some notional price. Okay, so notional means some assumption, not real sale. So this is not real sale, but the goods which we are transferring to the receiving department, we are fixing some assumption price, notional price. That is not a real sale, but for performance evaluation only, we are assigning some price, sir. Okay, now let's say for example you have fixed some notional price of 80 rupees. They're transferring at 80 rupees. Their cost is 50 rupees, so that they will get a profit of 30. If they could be able to reduce this cost to, so from 50 to, if they're able to reduce the cost, they will get more profit. Okay, so now this notional price is there, na? Notional price means what, sir? The dummy assumption price, the price, some notional price at which one department is transferring goods to the another department within the organization, internal transfer. Okay, that notional price is nothing but transfer price, sir. Now in this chapter, we have to decide the transfer price, how much, how to calculate the transfer price and all we need to decide. So now what is the problem here? So to calculate the transfer price, we are having different transfer pricing methods. Each method will have some positive point and negative points. Merits and demerits will also be there. Okay, so first of all, what is transfer price, sir? It's a notional price at which one department transfers goods or materials to another department. Okay, that is not real sale, but some dummy sale, dummy transfer. So dummy sale only. Okay, so why we are fixing some transfer price means to evaluate the performance of two departments. Okay, now see for example, let's say different transfer pricing methods will be there. For example, this glass manufacturing division is transferring items at full total cost, sir. Total cost means variable cost plus fixed cost. They are adding total cost. At this total cost, they are transferring some semi-processed good to the another department. Here, glass bottle. Okay. So now here variable cost means variable part. Fixed means this is fixed for this point of transfer or department point of view. This is transfer or department, transferee department. Okay. So this particular total cost is having some variable part and some fixed part. When they are transferring these items, this product to the receiving department, the total transfer price will be treated as variable cost, sir. Are you getting this point? Okay, originally okay, this transfer or division can transfer the goods at whatever the transfer price they want to calculate. Different methods are there. Let's say for example they are transferring at variable cost plus fixed cost. That means at total cost they are transferring. In the total cost, some fixed part also there. Fixed cost means that is fixed irrespective of output level. Okay, once this fixed cost part is also being transferred, but so to receiving department, the transfer price is treated as material cost. That means pure variable cost. Here in the transfer price we have fixed cost, but once it moved to the receiving department, that entire cost, variable or fixed, that is being treated as pure variable cost. Okay, within the organization, at one department cost is fixed, at another department is that becoming variable cost, fixed becoming variable cost. Then in this situation, what will happen means, by using this total cost, variable plus fixed, but the same cost being treated as a variable cost here, if you calculate the profit maximization output means what, sir? The output at which they will get maximum profit. Different output levels will be there, sir. So equilibrium point, we call it as equilibrium point. Equilibrium point means the output level at which a department or organization is getting maximum profit. Okay, by taking this variable cost plus fixed cost, here we get one equilibrium point, let's say some 10,000. Here at the transferee, by taking the same transfer price as variable cost, if you calculate the equilibrium point, this will get a different equilibrium point. Let's say he will be getting 10,000 units as equilibrium point. He is getting 5,000 as equilibrium point. What is equilibrium point, sir? Equilibrium point means the point at output level at which the department is getting maximum profit. Now, transfer department is one equilibrium point, transferee department another equilibrium point. So, but they will always try to maximize their own benefits. Own benefits means what, sir? This transfer department always wants to transfer 10,000 units. But this transfer department will never take more than 5,000 units. Why means this is their optimal output level. Then there arises goal congruence. So goal congruence means what, sir? Goal congruence means overall organization is having one objective. But so individual departments are having their own objectives, own interest. Okay, instead of achieving overall organization objective, if divisional managers are trying to maximize their own individual benefits, that situation is called as goal congruence. Okay, so to resolve that goal congruence, we have to fix a transfer price range. Transfer price range means minimum level will be there, maximum level will be there. This is the transfer price, minimum transfer price, maximum transfer price. We need to fix this one, sir. Before fixing that minimum and maximum level of transfer price, we need to understand transfer pricing methods. Different methods are there. Okay, till now, are you okay with this one, sir? Okay, two types of structures are there: centralized, decentralized. Centralized, so everyone wants to take credit if they are getting profit. No one take responsibility if they are getting losses. For that, to assign some responsibilities to the divisional managers, so there is new structure came into the picture, that is decentralization structure. Okay, top level management, under them different divisions, each divisional manager. Now, top level management will give some targets to the divisional managers. So to give some targets, different basis will be there. That's why we are considering four types of divisions: cost center, profit center, revenue center, investment center. Cost center target is target cost. Revenue center target is target revenue. Profit center target is profit, target profit. Here investment center target will be return on investment. Okay, like that we will be fixing some targets. Okay, so if they are achieving targets means fine, not achieving targets means not fine. So here we have taken one example, two departments, bottle liquid manufacturing divisions. Bottle manufacturing divisions, if they are being treated as profit centers, we also need to calculate, to evaluate the performance of bottle manufacturing division manager, we have to calculate profit now. But he is incurring cost only, he is not getting any revenue. For that, what we are doing is like, the units which they are transferring to another department is being assigned with some notional price. Why that notion? That notional price is treated as nothing but selling price, sir. Is that real sale? No, the dummy sale only. We are treating that as some kind of sale. Why, sir? So that we can calculate the profit of transfer or division. That notional selling price is there now, that is called as transfer price. Why this transfer price, sir? Means to evaluate the performance of divisional performance calculation. Okay. So, but the problem is to calculate the transfer price, we are having different transfer pricing methods. Okay, you see three types of methods are there broadly: cost based methods, market price based methods, negotiation based transfer pricing method. Okay, so whatever the method, each method is having some merits and demerits. Okay, So but the problem here is like whenever transferor department is transferring at total cost or else at total profit, sorry, selling price is transfer price is being fixed as let's say for example total cost plus profit. In the total cost they will be having some part of fixed cost. Once that has transfer to transferee division, that entire total transfer price is being treated as variable cost. So if you purchase materials from external market, material cost is variable cost. Now transferee department treats the transfer price as variable cost. Goal congruence will occur, sir. How goal congruence means? Equilibrium point will be different for two divisions. Okay, they will always try to maximize their own individual objectives, keeping aside the overall organization objective. Okay, so that situation is called as goal congruence. What is goal congruence means? Okay, individual departmental managers try to achieve their own interest, own objective, irrespective of overall company objective. Two different objectives. Okay, goal congruence, that is called as goal congruence. To resolve that one, we have to fix transfer price range. Okay, so before discussing, so this is the main part, sir. If you understand that transfer price range fixing and all, chapter is over. That's it, that much easy. Now, so before discussing about the transfer price range, transfer price methods. So first one, here we have three types of methods. Okay, cost based method, market price based method, negotiation based method. So cost based method. So cost based method means first one, variable cost based transfer pricing. Variable cost means nothing but marginal cost. Okay, so whatever the variable cost you will incur, that is the transfer price. Like that we can fix. Or else variable cost plus fixed cost, total cost. Okay, so first method, variable cost method. If transfer price is variable cost, okay, they will not recover their fixed cost, right? So transferring at only variable cost means they will also incur some fixed cost like supervisor salaries, rental cost and all. They will not be able to recover fixed cost, that is the demerit. Okay, next one, second one, variable cost plus fixed cost, total cost method. If total cost method, what is the problem we are discussing is like here it is fixed cost, but when that goes to transferee department, that is fixed variable cost, goal congruence. Third one, cost plus margin. So cost plus margin, here also we are having fixed cost, that will be treated as variable cost. Okay, so how to fix that margin, sir? How to fix that margin means that margin can be calculated so as a fixed number, profit, or else percentage of profit on percentage of margin on cost, or else percentage on sales, or else third one, return on investment. Total cost plus some margin. What is that margin means? That can be profit, or else percentage of profit, or else some return on investment also we can add. Okay, fourth one, standard cost. Here, so we are fixing some standard cost. At that price only they have to transfer the items. Okay, that standard price cost, standard cost. So if you are fixing transfer price at standard cost, what is the problem, sir? The problem is like so they will always try to achieve that standards. They won't do any creative thoughts, they won't do any innovation for reducing the cost. That is the problem. Okay, last one, cost plus shared profit method. Okay, so shared profit means what, sir? Cost means variable cost plus fixed cost. Okay, fine. What is the shared profit, sir? Shared profit means say for example, transferor, transferee, he is transferring an item to transferee at what price, sir? Okay, see, transferor cost of producing that particular item is 50 rupees. To that 50 rupees they will add some profit, they will make some, calculate some transfer price, sir. Okay, so at the transfer, see, sorry, no, this one. So transferor incurring some cost. Now we don't know some what is the transfer price and all, we don't know, sir. Transferor incurring some cost of 50 rupees. Now transfer is also incurring some cost of 100 rupees. Let's say same example, beer manufacturing company. So transferor make a beer bottle, glass bottle. They are producing that bottle at 50 rupees cost, sir. Now that is transferred to transferee. How much transfer price? We don't know. Let's say transferor 50 rupees incurring and transferring to the transferee. Here transferee is also incurring some 100 rupees cost on the same bottle. Okay, making it as a finished good. Okay, now what is the total cost they are incurring means 50 rupees by transferee 100 rupees incurring on the product. Now that product is being sold in the external market at 250. Are you okay with this example? Transferor cost 50, transferee cost 100, so total 150 is the cost. They are selling it in the external market at 250. Now what is the overall organization point of view? What is the profit, sir? 250 is the selling price, 50 rupees transferor cost, 100 rupees transferee cost, the profit is 100 rupees. Now overall profit 100 rupees is what? Overall profit. Now this overall profit has to be distributed between transferee and transferor at their cost ratio. See. Okay, this is overall profit, sir. Now this profit has to be distributed between transferee, transferor. In which ratio, sir? In their cost ratio. This 100 rupees profit will be distributed between them. In which ratio means 50 is to 100 ratio. Okay, 100 rupees. 50 is to 100 means 1 is to 2. Okay, now 1 is to 2, distribute this profit, sir. 100 into 1 by 3. How much? 33.33. Okay, write it 33.33. So now what is the transfer price, sir? Cost plus their shared profit. Shared profit means what, sir? Overall profit is shared in the ratio of cost. Okay, 83.33 is the transfer price. Okay, what is their so profit means what is the share of profit of transferee means 100 rupees into 100 into 2 by 3, 66.67. In total 166.67. This is their cost, this is their profit. That's it, sir. Simple. Okay, now are you guys okay with this shared profit method? Cost plus share of profit. What is that share of profit, sir? What is that profit means? Overall external market. How much overall profit we are getting by selling in the external market? That profit is shared between two divisions in their cost ratio. That is called shared profit. Cost plus shared profit. Okay, that's it. That is the transfer price. Okay, now coming to market price. Market price means whatever the external department, so external market price, at that price only transfer which division will transfer. Let's say division A is there, division A is there, division B is there, sir. Division A transferring some semi-processed good, let's say X, to division B. Okay, how much is the transfer price means if division A can sell the same product X, semi-processed good X in the external market, let's say for example 50 rupees. This is what's our external market price. Now what is the transfer price means under market price method, transfer price is equal to market price. At which price A has to transfer to B item X means market price 50 rupees only. Last one, negotiation based method, sir. Negotiation based method means, okay, division A manager, division B manager comes together, they will sit, will have some talk or negotiation. Okay, finally they will fix one price. That price is called transfer price. Simple. So what method? Broadly three types of methods: cost based, market based, negotiation based. Cost based different. So that methods will be given in the question itself. Variable cost plus fixed cost, total cost, or else cost plus margin. Margin can be calculated in three ways: fixed number, or else percentage, or else return on investment basis. Or next one, standard cost. Last one, cost plus shared profit method. Okay, so sometimes cost plus opportunity cost, sir. So here we have one more type, that is cost plus opportunity cost. General cost incurred plus opportunity cost. Okay. Now coming to fixing transfer price range, sir. So how to what is transfer price range means? That range is minimum limit, maximum limit. minimum limit, so minimum transfer price, maximum transfer price. Minimum transfer price we fix from transferor point of view, maximum transfer price we fix from transferee point of view. Okay, so this minimum transfer price, transferor seller point of view, maximum transfer price from buyer point of view. First of all, let's discuss transferor point of view. From transferor point of view, we fix what price? Minimum transfer price. Minimum transferor point of view. So, what is the minimum price below which seller will not sell the product? Let's say you are going to a vegetable market. Okay, so he told you like, so 1 kg tomatoes 100 rupees, but you will bargain, right? Okay, he will be, so you will start your bargaining with 20 rupees. He says 100, you says 20. Okay, next you says 30, 40, 50. Okay, finally, so he will be ready to sell that 1 kg tomatoes at 60 rupees. That means minimum 60 is his price at which he will be able to, so he is willing to transfer. Okay, now how to calculate this minimum transfer price? Before, so to fix this minimum transfer price, you have to know the capacity of transferor. Okay, whether the capacity is surplus capacity is there or surplus capacity is not there, we have to check. Okay, now say for example, so the transferor is having 1 lakh capacity, that means he can produce 1 lakh units. Now, so at current, at presently, he is having 1 lakh units capacity, but currently he is producing 60,000 units only. He is producing 60,000 units only. That means 40,000 is what, sir? Surplus capacity. Okay. In this situation, now, so transferee division is coming to transferor division and asking to transfer some 30,000 units. Do we have surplus capacity to produce this 30,000 units? Yes, we have 40,000 units surplus capacity. He is asking 30 only. Okay, even if you ask 40,000, we have surplus capacity. Okay, so if you have surplus capacity, what is the minimum price means? Okay, so in that situation, as I am having surplus capacity to produce that 40,000 units, I will incur only variable cost. Na? Okay, only with the variable cost I can produce. Variable cost, marginal cost, incremental cost to produce one more additional unit. Okay, we have to check what, sir? For this 40 additional units, whatever the transferee department asking, for that we will incur only variable cost. That's why minimum transfer price is variable cost only. Are you okay with this point? If you have surplus capacity, we incur what? Only variable cost to produce that product. We won't incur any fixed cost. Okay. Now, if there is no surplus, sir, if there is no surplus means what will happen, sir? See, capacity 1 lakh. Presently, I am producing 1 lakh units and selling in the external market. I am not having any surplus capacity. Now, in this situation, transferee department is coming to transferor department asking for some 40,000 units, let's say. Now, to produce this 40,000 units, do we have surplus capacity? No, our maximum capacity is 1 lakh. That one we are already producing. That means to produce this 40,000 units, we have two alternatives. What are the two alternatives, sir? One is increase the capacity. Capacity means what, sir? That capacity will be decided by number of labor they are having. Okay, number of machines or machine hours they are having. Raw material availability they are having. That decides the capacity. Okay. So now to increase the capacity, we will incur some capital investments. Sir. Let's say, for example, we have some machines. That machines only produce 1 lakh units. That we are producing in the maximum extent and selling in the external market. Now to produce additional 40,000, we need new machines. Capital investment. So capital investment means interest cost will be there, opportunity cost. Okay. So normal cost plus opportunity cost we have to consider. See, this is not that much important point, sir. But the most of the repeated point is, most of the times this point only repeated in the questions. Okay, if I am not having any surplus capacity to produce 40,000 units, okay, anyway transferee division, let's say division B, they're asking to transfer 40,000 units. but I am having no intention to increase the capacity. Then what I will do is like, externally I am selling, I am producing 1 lakh units, okay. 1 lakh units I am selling in the external market now. Now, so out of this 1 lakh units, sacrifice some 40,000 unit sales in the external market and transfer these 40,000 units to transferee department. Are you getting this point? Sacrifice external sales. So we are selling 1 lakh units in the external market. Now transferee is asking for 40,000 units. What we do is like, in external market I will sell 60, 40,000 I will transfer. Okay, so what is the effect of this one, sir? What is the effect means? So just to transfer, if I am not transferring to transferee department, I would have sold that units in the external market. In that case, I would have got some contribution or profit. But I am sacrificing not only that sale, the contribution on that sale I am sacrificing just to transfer to transferee. Okay, so this sacrifice in external market sales will have some opportunity cost that we need to consider. Okay, now what is the transfer price means? Transfer price is equal to, you linker some variable cost to produce the product plus opportunity cost. What is opportunity cost, sir? If I sell in the external market, I would have got some contribution. That contribution is opportunity cost here. Okay, so what is the minimum transfer price, sir? Minimum transfer price, if you are having surplus capacity, variable cost. If you are not having surplus capacity, variable cost plus opportunity cost. Okay, na? Next one. So maximum transfer price, sir. Minimum transfer price we fix from whose point of view? Transferor point of view. Maximum transfer price. Maximum transferee means he is the buyer. Okay, so from buyer point of view, maximum price how much he will be he can pay. Okay, let's say you go to the market, but so they are saying 1 kg tomatoes 1,000 rupees. Okay, do you pay, do you purchase 1 kg tomatoes at 1,000 rupees? No. Okay, in your mind you will fix some maximum price. That much price only you will pay. That means from buyer point of view, maximum how much he will pay. Transferee point of view, how much he will pay. That we are discussing here. Okay, see. So maximum transfer price. Let's say from A to B, we are transferring an item called X. Maximum how much B can pay means maximum transfer price. So first one we have to check is external market price. Okay, say for example the same unit X B can purchase from external market at 45 rupees. Then maximum he will pay 45 rupees to division A, right? More than that he will not pay. Okay, now so if A is asking 50 rupees, but the same unit B can get in the external market at 45 rupees, then maximum how much you will pay, sir? 45 only. Even though if I purchase from external market, 45 rupees is the cost, that only I will pay. So the 50 rupees you are asking, I will not pay that one, that they will say. So next one. So here external market price means not just market price, sir. Purchase cost we need to consider. Sir, what is this purchase cost, sir? Purchase cost means external market price is 45 rupees. To bring that item or product from external market to our company, our division, we will incur some 3 rupees transportation cost, let's say. Now, by the time that product X reaches to the division B, what would be the cost, sir? Market price 45 plus transportation cost 3 rupees, total 48. That means maximum B can offer 48 to the A. Okay, so okay with this point. External purchase cost, not purchase market price. Purchase cost means if they are incurring some so transportation cost, you need to consider that one as well. Or else marginal, net marginal revenue, sir. Sir, what is this net marginal revenue, sir? Net marginal revenue means A is transferring some item to B, sir. That is item is X. Okay. So see, this semi-processed good B is converting to product Y. They are selling in the external market for 150. This is the story, sir. A transferring some semi-processed good X, like glass bottle, glass beer bottle, They're transferring X item to B. They're making it to the complete beer. That means finished good. Why? They're selling it on the external market at 150. Now, what is net marginal revenue means? From that 150, what is the B cost? B is incurring 50 rupees cost. B is incurring 50 rupees cost to produce that, to convert X into Y, 50 rupees cost they are incurring. Now 150 is the external revenue minus B own cost 50 rupees. So 100 is the net marginal revenue. Okay, now what is net marginal revenue means? B is selling in the external market for 150. Their own cost is 50. Subtract that, recover their own cost 50 rupees. Then they will get surplus of 100 rupees. Na? Net marginal revenue. Maximum this 100 can be offered to A. Okay, that's it. So transferee external selling price minus transferee own cost net marginal revenue. From transferee maximum transfer price is external selling price minus their transferee own manufacturing cost. You will get net marginal revenue. This price can be the transfer price. Okay, this point is not being asked, but this is the point, sir. What is the maximum price means? So transfer price range, minimum price, maximum price. Maximum price, external market price. That means external purchase cost or else net marginal revenue. What is the minimum price? Minimum price, if you have surplus capacity, variable cost. If you are not having surplus capacity, this formula. So transfer price is equal to variable cost plus opportunity cost. Okay, so that opportunity cost can be, so sacrificing cost. Sacrificing cost means external sales we sacrificing na contribution on that sales is opportunity cost here. Or else if you want to increase the capacity, you will do some capital investment. Capital investment means some interest cost will be there. That is opportunity cost, sir. Okay, so these points enough. We can directly go and solve one problem, but so once again go through these points. Types of markets, transfer price, minimum transfer price, maximum transfer price. Just once again see, look at the screen. I think I have already shared this PDF in the group. Okay, later you can take that one, print if you need it. Otherwise that is enough. Go to our workbook. Workbook, page number 3.3.1, transfer pricing methods, sir. In the question itself, they will give some methods and all. We need to calculate transfer price under different methods. Now, just read this question once. We'll solve this one. Afternoon time, we have taken lunch, getting sleep, huh? Okay, 10 minutes, be focused. Focus on this particular problem. Okay, have you gone through that problem? Okay, done. Okay, now see. Transferor Limited has two processes, preparing and finishing. Okay, the normal output per week is 75,000 units completed at a capacity of 75%. That means currently they are producing 7,500 units at 75% of capacity. That means what is 100% capacity, sir? 10,000 units. They are having surplus capacity or not? Presently they are producing 70,500, means they are having surplus capacity of 2,500 units. Transferee Limited had production problems in preparing and requires 2,000 units per week of prepared material for their finishing process. Okay. Another Transferee Limited, another limited is there, sir. Then they are having some problems in preparing process. They need 2,000 units per week of prepared material for their finishing process. Okay, see what is actually happening here is like transferor, transferee. Two divisions, two companies or divisions are there, sir. So transferor is having capacity of 10,000 units, but presently they are producing 7,500 units, surplus capacity of 2,500 units. Okay. Okay, they can do two processes, preparing and finishing, but transferee is having problem in preparing. Okay, so if transferor prepares that unit, prepared unit, if they send it to the transferee, they will finish it. So finishing process, after that they will sell it in the external market. Sell. This is the process. Preparation. So what is the product that will be prepared and finished? Preparing, finishing. Okay, some product. Generally tell me some examples which product will be prepared and finished. Finishing means what, sir? Chicken cutting, preparing, next finishing. So something like that we can assume, whatever the product it is. Preparing, finishing. Okay, external selling. This is the story they are telling, sir. Now in that story, read the cost structure. The existing cost structure of one prepared unit of transferee limited at existing capacity is as follows. Okay, so what is the cost? Material cost 2 rupees, 100% variable. Labor cost 2 rupees, 50% variable. Overhead 4 rupees, 25% variable. The sale price of a completed units of transferor limited 16 with a profit of 4 per unit. Okay, so next, that means for how much they are selling, sir? So sale price how much? 16 rupees. Sale price itself is 16 rupees, sir. See, sale price is 16 rupees. What is the profit? Minus 4 rupees. That means what is the cost? 12 rupees. Okay, so out of this 12 rupees cost, there will be two types of cost. Say I'm writing on chart here. 16 rupees selling price with a profit 4 rupees. 12 rupees is the cost. This cost will have two parts: preparing, finishing. Okay, that preparation will be done by whom, sir? Transferor. That finishing will be done by whom? Transferee. Okay. So what is the cost of transferor? Transferor cost structure is material cost. Material cost how much? 2 rupees variable. Okay, let's divide this cost into material cost, variable cost, fixed cost. Material cost 2 rupees, complete fixed. Okay, next one, labor cost. Labor cost 2 rupees, 50% variable means 1 rupee, 1 rupee. Overhead cost 4 rupees, 25% variable means 1 3. 4 rupees variable cost, 4 rupees fixed cost, total 8 rupee. Out of 12 rupee cost, preparation cost, that means transferor cost is 8 rupee. Remaining 4 rupees is what? Finishing transferee cost. Okay, that means we can assume it like transferor incurring 8 rupees cost, transferee incurring 4 rupees cost. That final good is being sold in the external market for 16 rupees. The profit is 4 rupees. Okay, are you okay with this calculation? Okay, now required. Construct the effect on profits of transferor limited for 6 months. 25 weeks, supplying units to transferee limited with the following alternative transfer prices per unit. See how many units they need, sir. Transferee department asking how many units? 2000 units per week. Okay. Construct the effect on profits of transfer limited for 6 months, 25 weeks. 25 weeks means each week how much they have to transfer? 2000 units. 25,000, 25 into 2000. In total, they have to transfer 50,000 units. Okay. So with the following alternative transfer prices. See, transferor capacity is 10,000 units. They are currently producing 7,500 units, surplus capacity of 2,500 units. Transferee needs how many units? 2,000 units. Okay, to produce these 2,000 units, what is the cost of transferor? Can you tell me that cost? Okay, so they need to produce the 2,000 units now. Only variable, excellent, Amma. Okay, so they're having surplus capacity 2,500. Now transferee is asking 2,000 only. That means surplus capacity we are having. So that means to produce the 2,000 units, each unit for 1 unit, what cost they will incur means only variable cost. Why, sir? Surplus capacity, na? Okay, additional fixed cost won't be there. Okay, so 4 rupees cost they will incur, sir. Their production cost is 4 rupees only. That's it. Now, so first point, first method, what they're asking, sir? What is the first transfer pricing method? Marginal cost. So marginal cost method. Okay. What is their cost of production to produce 1 unit? Cost they will incur is 4 rupees. Now, what is transfer price? Transfer price is at a marginal cost, nothing but variable cost 4 rupees. So they are transferring at 4 rupees. Their cost is 4 rupees. What is the profit? Profit is equal to 0. Okay, what is the profit of 50,000 units? 50,000 into 0, 0 only. First point, first method. Second method. Look at the question and tell me what is the second method. Marginal cost plus 25% of margin. Okay, so cost how much, sir? Transfer price. Let's calculate transfer price. That is equal to marginal cost 4 rupees plus 25% means 5 rupees. What is their cost? 4 rupees they will incur to produce. Profit 1 rupee profit. Are you able to understand this one? Okay. Okay, this transfer price, this cost. Transfer price is like a sale. Cost is how much we are incurring to produce that one product. What is the profit of 50,000 units? 50,000. Third method. Third method is what, Amma? Marginal cost plus 15% return on capital. So assume capital employed is 20 lakhs. Now this is the point. Marginal cost plus 15% of return on investment. Okay. So now what is the transfer price, sir? Transfer price is equal to marginal cost. That means 4 rupees marginal cost plus return on investment. Return on investment how much? 20 lakhs. 20 lakhs into 15 percentage. How much? 3 lakhs. Okay. So that 3 lakhs is per annum per 6 months? Per annum. But here the transfer price, transferring period is period of transfer 6 months only. Since that 3 lakhs is for per annum, no, we need to consider only 6 months return. 6 by 12 months. 1,50,000. Okay. So they need to recover total 1,50,000 as their return on investment. Now that 1,50,000 we need to recover from how many units? Over the period of 6 months, how many units they are transferring? 50,000, right? Divided by 50,000. Okay, are you getting this one? In the denominator, over the period of 6 months, they are transferring 50,000. Numerator, for that 6 months, they return on investment. How much, Amma? 8, huh? 4 plus, this is how much? 3, huh? That means 7 rupees. What is the cost? Cost is 4 rupees. Profit is equal to 3 rupees. 3 into 50,000 total profit 1,50,000. This 1,50,000 is nothing but return on investment only. Okay, we will write a note point, sir, for this 50,000. How we got 50,000 means, okay, weekly 2,000 units for 25 weeks 50,000. Okay, why we are taking 6 by 12 here, sir? Means so 6 months period only. This return is for annum. See, next one, point number D. What is next method? Existing cost means how much? Existing cost means total cost. Existing cost, that is equal to total cost, that is equal to how much? 8 rupees. Transfer price is equal to total cost, that is equal to 8 rupees. What is the cost they will incur to produce means only variable cost 4 rupees. What is the profit? 4 rupees per unit. For 50,000 units, 2 lakh is the profit. Done. What is our next method? Existing cost plus a portion of profit basis of nothing but that formula is nothing but shared profit method, sir. Shared profit formula, direct formula they are giving. Existing cost plus shared profit. Okay, what is transfer price means? Existing cost. How much are existing cost? 8 rupees plus share of profit. Total share of profit, total profit how much? 4 rupees is total profit now. If you sell it in the external market, 4 rupees is total profit. This 4 rupees is to be divided between transferor and transferee at their cost ratio. What is their cost ratio? 8 is to 4. Okay, now let's divide. 4 rupees is the profit that they have to distribute in their cost ratio. Okay, total cost 8 plus 4 is 12. Out of the 12 rupees profit, 8 rupees cost is being incurred by transferor. Are you okay with this calculation? 8 is to 4 ratio, we are dividing 4 rupees. 8 is to 4 ratio means 8 plus 4, 12. Okay, transferor cost 8 rupees. Okay, how much? 2.6. Total 10.6. Cost 4 rupees. Profit per unit 6.6. Total profit 3 lakh. 1 minute. 3 lakh 33,500. Last one. At agreed market price of 8.50. EF. Transfer price is equal to market price 8.5. 8.50. Transfer price 8.50. Cost 4 rupees. Profit 4.50. Total profit 2,25,000. That's it. Enough. That's it, sir. So first one, we need to write this chart. Working note 1. Sir, can we present the data like this, sir? Okay, fine. We can write the data even in charts. Okay, but you should not write shortcuts, sir, like this SP, selling price minus profit, cost, pre-means preparation, finishing, transferor, transferee, material cost, labor cost. This one is variable overhead cost. Okay, another point we need to calculate is how we got 50,000 units. Write that point 1 note. Total requirement of transferee 2,000 units per week into 25 weeks, 50,000 units. Another note 2, return on investment 15%. Okay, so that is equal to return on investment per year 2 lakh into 15%. Return on investment for 6 months 1,50,000. Done. Now, okay, read this question number 3, sir. Residual income based transfer price. Question number 3. Done reading this one. 3 only, na? Okay. Have you gone through that question? There in old material as well. So, SMQ 23. Which page, sir? Okay. No, got it. Yes. See, in this question, calculate the transfer price which alpha should go to beta to achieve its budgeted residual income. Sir, what is that residual income, sir? Residual income means, okay, let's say, so in the format of income statement, sales minus variable cost, we get contribution, minus fixed cost, we get profit. So from that profit, if you subtract return on investment, let's say to earn that profit, I have invested some 10 crores. From on the 10 crores, so at least opportunity cost will be there, na? Or else my expectation on that investment return, let's say 10 percentage. Means what? 10 crores into 10 percentage return. Okay, so 1 crore. 1 crore is my return on investment. From the profit I have earned, so if you subtract return on investment, that return on investment means nothing but cost of capital. Okay, so normal accounting profit minus cost of capital. You will, if you have any surplus, that is called as residual income. Okay, now, so limited which has assessment of divisional performance on the basis of residual income to two divisions. Now see, two divisions alpha and beta managers are being evaluated. Their performance is being evaluated based on residual income. Then they will try to so earn maximum return on residual income. Alpha and beta, alpha has annual capacity of how many numbers? 15 lakh numbers of special component that it sells in the outside customers, but has idle capacity. Okay, budgeted residual income of beta is so for beta they are giving residual income how much, that is 1 crore 20 lakhs. While that alpha target is residual income how much? See, here their target is based on residual income. Okay, they will always try to achieve their targets. Okay. Other relevant details extracted from budget of alpha for the current year was as follows. Sale to outside customers, sir. 12 lakh units they are selling, 180 rupees per unit. Selling price. This 180 is what selling price. Variable cost per unit 160. So can you tell me the contribution here? So 20 rupees they are getting contribution from external market. In external market, how many units they are selling? 12 lakh units. 20 into 12 lakh. How much? 2 crore, 2.40 crores. Okay. That means from external sales itself, they are getting how much contribution? 2.40 crores. Okay. Divisional fixed cost 80 lakh, capital employed 7 crore 50 lakhs, cost of capital 12%. That means what is the return on investment or else cost of capital? 7.7 crores 50 lakhs into 12 percentage. How much? 90 lakhs. Huh? Okay. Beta has just received a special order for which it requires components similar to that made by Alpha. Fully aware of ideal capacity of Alpha, Beta has asked Alpha to quote for the manufacture and supply of 3 lakh number of components. Okay. With a slight modification during the final processing. Okay. So now Beta is asking Alpha to transfer how many units? 3 lakh. 3 lakh surplus capacity is there. Huh? Yes, the total capacity is 15 lakh. Externally, they are selling 12 lakh. Okay, 3 lakh surplus is there. Okay. Alpha, beta agree that. What the adjustment B is asking? Beta is asking alpha 3 lakh components with a slight modification during final processing. Okay, slight modification also they are asking, sir. Alpha, beta agree that that slight modification will involve extra variable cost of 5 per unit. Okay. So now we need to calculate what? Calculate transfer price of alpha. How much alpha has to quote? See, again, let's say we need to understand the story again. Alpha, beta. Alpha is having 15 lakhs capacity. Presently, they are selling 12 lakhs in the external market. 3 lakhs surplus is there. Beta is asking alpha for 3 lakh units. Okay. So, alpha, the same unit alpha is selling in the external market. In the external market, they are selling for how much? 180 rupees. Alpha budget only, na? They are selling in the external market 180, variable cost 160. They are selling in the external market for 180 selling price. External selling price. So alpha variable cost is 160 rupees, that was given in the question. Okay, to transfer to the beta, so beta is asking some modifications in the product. Okay, with that modification they will incur 5 rupees additional cost. Then in this transfer, if beta wants to transfer, alpha wants to transfer to beta 3 lakh units, what is the variable cost means? Variable cost 160 plus 5 rupees they will incur, 165 is the variable cost. If they transfer to beta, are you okay with this? Okay. Now, so alpha beta performances are being evaluated based on what? Residual income. Residual income means they'll always try to achieve that residual income. Okay, so keep it aside. Let's discuss the target of alpha. So what is alpha target means? Sales minus variable cost, we will get contribution. From that contribution, if you subtract fixed cost, you will get profit. From that profit, if you subtract return on investment, you will get residual income. Okay. Now, so alpha target of residual income is how much? 1 crore. 1 crore is the target. 1 crore only. Yes. 1 crore is the target residual income. How much return on investment they have to earn? They are having investment of 77 crores, 7 crore 50 lakhs into 12 percentage, 12 percentage of something. Okay, 90 lakhs. Okay, so that means they need to earn how much profit? Okay, so if alpha want to earn residual income of 1 crore, return on investment of 90 lakhs, they have to earn a profit of 1 crore 90 lakhs. Okay, what is their fixed cost? 80 lakhs. Okay. Okay, if alpha has to get profit of 1 crore 90 lakhs, they're having fixed cost of 80 lakhs. That means how much contribution they have to generate? 2 crore 70 lakhs. 2 crore 70 lakhs, right? Okay. So their target contribution, okay, to achieve this residual income or else to this profit or else to contribution. So, sorry, to achieve this residual income, alpha has to earn contribution of 2 crore 70 lakhs. Okay. Now, their target is 2 crore 70 lakhs. Okay, whatever the sales, they have to generate 2 crore 70 lakhs. But currently it is selling in the external market now. How many units they are selling? 12 lakh units into contribution. Contribution on each unit, how much? 180 is the selling price minus 160 is the variable cost. External market variable cost 160. That means they're getting 2 crore 40 lakhs in the external market. Okay, so alpha target is 2 crore 70 lakhs. External market they're already getting 2 crore 40 lakhs. That means remaining contribution, how much they have to generate? 30 lakhs. This 30 lakhs they have to generate from what? Internal transfer. Okay, alpha can make what? External sales, internal transfer to beta. External sales. Already in the external sales, they are getting 2 crore 40 lakhs contribution. Their target 2 crore 70 lakhs. Remaining surplus they have to recover from internal transfer. Okay. Now how to calculate transfer price, sir? Transfer price is equal to their transfer price should earn them residual income of 1 crore. To earn that residual income of 1 crore, they have to generate contribution of 2 crore 70. To generate this one, already they are generating 2 crore 40, no, 30 only they have to recover from internal transfer. Okay, so how to recover, sir? So at least, so here as they are having surplus capacity, what is their cost of production? Surplus capacity. What is their cost? They will incur variable cost. Okay, along with the variable cost, they have to recover what? 30,000 contribution. Okay, that means contribution, target contribution. Target contribution. This target contribution has to be recovered from how many units? How many units they are transferring, sir? 3 lakh units, huh? Okay, 3 lakh. Okay, what is the variable cost? Can you tell me? So the variable cost in transfer, internal transfer. Not that one. This is contribution. Only variable cost 160 plus beta is asking what slight modification. For that modification, 5 rupees is there, na? Yes. Okay, target contribution, how much we have to generate from internal transfer? 30,000 divided by, sorry, 30 lakhs. Sorry. 165 plus 10. 175 is transfer price. Are you okay with this calculation and all? After this 270. Okay, what is alpha target? Alpha division target is to earn 1 crore residual income. That is their target. To earn 1 crore residual income, they have to earn 2 crore 70 lakhs as a contribution, right? Okay. So how alpha can generate contribution means from external sales or from internal transfer? Already external sales, how much contribution they are generating? 2 crore 40. Okay, remaining 30 they have to generate from internal transfer. Okay, internal transfer to beta. So from transfer to beta, they have to generate a contribution of 30 lakhs. Okay. So if, so generally see, if they are not having any targets, what is the minimum transfer price? Transferor will transfer variable cost only. What is the variable cost? 165. If they are not having any other targets, only 165 is the transfer price. But here the target is what? Achieving residual income. For that they have to recover 30 lakhs. To recover 30 lakhs, okay, so we are transferring 3 lakhs units na? And from each unit recover 10 rupees so that they can recover total 30 lakhs. They will achieve this target residual income. Okay, 175. Okay, so this is the calculation you can do, but this is somewhat simplified calculation. But if you go to the problem, they have given there, they have given. Okay, now that is that you won't understand, sir. Write it, write this one. But here you need to write a note point. If you want to write this one, fine. If you are not writing also, fine. I will share this one. Done. Okay, now let's discuss this small question. Okay, let's discuss this one and let's take a break. Then after the break, we will discuss remaining questions. Okay, go through that question once. This is small question only based on goal congruence. Okay, so goal congruence we have discussed now. What is that goal congruence means? Different objective, difference of objectives. Okay, so equilibrium point or else profit maximization output for one unit, one division is different, another division is different. Then what they have to do? So for that, this is the question. Go through this one. So we will discuss and decide. What? 1 to 7, 12 to 6. Yeah, super. Okay, if you have any problem, please tell. Not an issue. Okay. See, have you guys gone through that question? Please read it, please. Just 2 minutes, 2 minutes, quick reading. Question reading and understanding is very much important, sir. Done. See, a company with two manufacturing divisions is organized on profit center basis. Profit center basis. Underline that line. Study material question number 19. The same question is also there in old material as well. Profit center basis means what, sir? Okay, if that means if a division is being treated as a profit center, okay, the divisional manager performance will be decided on the basis of profit. Okay, that's why divisional managers will always try to maximize their profit. Okay, see, division A is the only source of supply of a component that is used in division B in the manufacture of product CLIM. One such part is used in each of the product CLIM. As the demand for the product is not steady, division B can obtain order from increasing quantity only by spending more on sales promotions and by reducing the selling prices. Okay, the manager of division B has accordingly prepared the following forecast of sale quantities and selling prices. What is the story? Two divisions are there, A, B. Both are profit centers. Okay, so B is manufacturing CLIM. For that, a component needed. That component is being produced by A. Now, A has to transfer a component to B. Okay, so B sales are not steady. So if they want to increase their sales, they have to reduce the selling prices. Okay, sales per unit. Sorry, sales unit per day. 1000 sales, average selling price 5.25. If they reduce the selling price to 3.98, they could sell 2000 units. If they reduce selling price to 3.30, they could sell 3000. 2.78, 4000. 2.40, 5000. 2.01, 6000. Okay, if they reduce the selling prices, sales will increase. So, theory of demand. The manufacturing cost of CLIM in division B is 3750 for first 1000 units. Okay, understand this one, sir. This is, if you understand this one means enough for this problem. Manufacturing cost of CLIM in division B is 3,750 for first 1,000 units. First 1,000 units cost is 3,750 and 750 per 1,000 units in excess of 1,000 units. That means what, sir? Okay, see, division B, right? So to produce this first 1,000 units, they will incur 3,750 rupees cost, right? If 1,000 units increases, their cost will be increased by 750 plus 750, 4,500. For one more 1,000, if 1,000 units increases, add 750, 5250. If 1,000 increases, add 750, 6,000. Are you getting this one? For every increment, so every 1,000 units increases, okay, cost will be increased by 750. 6750, okay, 7,500. Next one. Division A incurs a total cost of 1,500 per day for an output of 1,000 components, and total cost will increase by 900 per day for every additional 1,000 components manufactured. So similarly, what they are saying is like first 1,000 units, how much? So 1,500. Okay, yes. For first 1,500 for first 1,000 units. Next, 900 will increase. That means 2,000. So again, for every 1,000 units increases, 900 cost will increase. 3,300, 4,200, 5,100, 6,000. Are you okay with this calculation? This is A cost. This is B cost. Okay. The manager of division A states that operating results of division will be optimized if transfer price of the component set at 1.20. Transfer price directly in the question itself they are giving, sir, 1.20. Okay, has accordingly set the offer set and he has accordingly set the offer set transfer price for his supplies of component to division A. Okay, you are required to prepare a schedule of showing profit at each level of output of division A and division B. Now we need to calculate division A profit and division B profit. How to calculate the profit, sir? How to calculate the profit means for division A, what is the profit? Profit is sales minus cost generally. For division A, sales means transfer price. That division transfer or division, na? So sales means transfer price. What is the transfer price? 1.20. Let's say we need to calculate. So we will take units. Units 1,000 units, 2,000 units, 3,000 units, 4,000 units, 5,000 units, 6,000 units, like this we will take units. What is the sales of A means into 1.20. You will get a transfer price. The transfer price is sales minus cost. What is the cost, sir? Here they have given cost 1,500, 2,400, like that. Transfer price minus cost, you will get profit. Now come to the answer. Profit at each level of output. Units 1,000, 2,000, 3,000, 4,000, 5,000, 6,000 we have taken, sir. Okay. Sale value. What is the sale value of A means? That is transfer or division. Their transfer price is their sales. 1,000 into 1.2, 1,200. 2,000 into 1.2, 2,400. 3,000 into 1.2, 3,006. 4,000 into 1.2, 4,008. 5,000 into 1.2, 6,000 into 1.2, 7,200. Now, what is the cost? For first 1,000 units, their cost is 1,500. For every increase in 1,000 units, their cost will be increased by 900. Okay, add 900, 900, 900, 900. Cost, sales. Sales minus cost, profit. What is the profit? 1,200 minus 1,500. Loss of 300. 2004, 2004, 0. 3,600, 300, 600, 900, 1,200. So maximum highest profit they are getting at what? At 6,000 units they are getting highest profit of 1,200 rupees at 6,000 units. Okay. Okay, definitely division A manager will try to produce 6,000 units and he will be definitely willing to transfer 6,000 units only. But so coming to division B profit, sir. What is division B profit? How to calculate means sales minus cost. What is cost? Sales means different selling prices they have given in the question. For division B, different selling prices, quantity. This quantity into each selling price, you will get sales. Okay. Cost minus cost. What cost, sir? Division B own production cost. That is this one. 3750, 4500, 5250, 6000. So this is own cost. And also cost is transfer price is also cost to division B. Na? We need to consider. What is the transfer price, sir? We have already calculated here. Here the sale value of division A is nothing but transfer price. Now coming to division B profit. Okay, number of units 1000, 2000, 3000, 4000, 5000, 6000. Selling price, selling units into selling price, sales. Okay, so transfer price. This is sales, transfer price of A. This is cost. This transfer price is cost to B. Other manufacturing cost, B own manufacturing cost. Okay, this 2 is the cost, this is sales. This is sales, this 2 is cost. Sales minus this 2 cost will get profit or loss. This total they have calculated, this total. Okay, directly without this column also you can calculate. Sales minus cost, cost. You will get profit, 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 loss, loss. What is the highest profit here? 1060. 1060 is the highest profit. That means, okay, in out of all these alternative, division B is getting higher profit 1060 at 2000 units. Okay, now tell me, division B manager definitely want to produce how many units? 2000 only. Why means he is getting maximum profit at 2000. But division A manager will try to transfer how many units? 6000. Why means he is getting higher profit at 6000 units. That is goal congruence, sir. So A wants to transfer 6000, B wants to take 2000 only. Okay, they will be fighting for number of units. Okay, so this situation is called as goal congruence. That what we have to do, sir. Our priority is keep organization objective first. Okay, so now, so point A done a calculation completed. Division A profit, division B profit. Okay, now point B. Read that point B. Find the profit of company as a whole at the output level at which division A profit is maximum, division B net profit is maximum. Output at which division A profit maximum is division A profit output. Maximum profit output is 6000. What is the profit? 1200. So 1200. So division B profit is at that 6000 units, division B profit is 2640 loss plus 2640 loss. Okay, so if company has decided to produce 6000 units, A transferring 6000, B also taking 6000 units, means total profit how much? 1440 loss. Okay, let's say for example they have decided to produce 2000 units. Output at which B profit maximum. Okay, what is the profit? 60. So at this level of output 2000 units, A profit is 0. 1060 plus 0. 1060. Okay, so that is the point, sir. Division A net profit is maximum. Profit of the company, overall company profit. That means profit of A plus profit of B, at which division A profit is maximum, division B profit is maximum. Division A profit maximum at 6000 units, at that 6000 units company profit is loss. Okay, division E profit maximum output, profit maximization output is 2000 units, at that profit is 1060. Now third point, if company is not organized on profit center basis, what level of output? If company is not organized on not organized on profit center basis, then what we have to do, sir? At each level of output, calculate total organization profit. See, this is the table. So units 1000, 2000, 3000, 4000, 5000, 6000. At all these levels of output, division A profit we have already calculated. This one, division B profit, this one. Okay, so division A profits, division B profits. Add total profits. 3000 loss, 3000 profit, 0. 0, 1060, 1060, 300, 1050, 1350. Like that, if you calculate at all levels of output, overall company profit. Okay, so at what output level overall company profit is maximum? 3000 units maximum profit of company 1350 1350. Okay, so that means division A maximum profit output level 6000, division B maximum profit output level 2000, but we should not follow any of this goal congruence. Then they have to follow overall company objective. Overall company will get maximum profit of 1350 at 3000 units. Follow overall company objective 3000. That's it. That is simple point. Are you okay with this goal congruence? Okay, different objectives are there means goal congruence. To resolve that one, follow company objective. Simple. Keep your company first. Okay, so this is some basic questions only, sir. The main questions are like two questions are there. One is limiting factor question. Whenever there is a limiting factor, we have to take the decision based on contribution per limiting factor unit. Okay, that calculation is there in transfer pricing, marginal costing, throughput costing, linear program planning. So very very important. So okay, so we will discuss that concept, and on that concept we have one problem, we will do that one. And later strategic alternatives. So one question is there, different alternatives, strategic alternatives will be there. That alternatives we need to analyze. Two questions. One more question is there, calculation of return on investment percentage. Three questions. Three questions are past attempt questions only. We do that questions. Okay, then if we have time means, then we will go to the probability product life cycle. Okay, so if there is any chapter left means, tomorrow or day after tomorrow we can cover for that question number. Today's our target is question number 3, transfer pricing, target costing, ALC, asset life cycle, PLC product life cycle, and probability. Small chapters only. Okay, we can cover tomorrow also, but so we shall try to cover maximum as possible. Let's take a break for 15 minutes. We will meet at 4:15. Okay, so thank you. Sorry guys, I didn't check. Uh, is my voice audible now? Is any noise is there? Please let me know. Okay, so we'll meet you after a short break of 15 minutes. Thank you. See guys, next concept is limiting factor concept. Limiting factor. Limiting factor means what, sir? Limit. Sorry. Yeah. Hi. Hello, everyone. Welcome back. So, our next concept, limiting factor. This concept is there in marginal costing, transfer pricing, throughput costing, as well as linear program planning. Okay. So, very important concept. Whenever there is a limiting factor, how to take product mix decisions. Okay. See, this kind of decisions you might have learnt in CM enters or same concept. Okay, we call that limiting factor as bottleneck, constraint, key factor, governance factor. Different names are there. Okay, so now, so how limiting factor affects okay product mix decisions or else transfer pricing decisions? We have to discuss here. See, for example, let us take an example. So two companies are there. Let's say company X, company Y. So company X is producing three products. Product A, product B, product C. Three products it is producing, sir. Okay, see, next one. The contribution directly. So contribution from selling prices, selling price minus variable cost. We will get what, sir? Contribution. The contribution from product A, product B, product C given in the question directly, or else if they are not giving, they will give selling price and variable cost. We will calculate. Okay, let's say for example, if you produce and sell 1 unit of A, you will get 10 rupees contribution. Here it is 20 rupees contribution. Here it is 15 rupees contribution. Let's say variable cost of product B is 9 rupees. Okay, other information not needed here, as we are discussing example only. Generally, if only contribution information is given, okay, you are so division X or else company X manager. Okay, now which product you will prefer to produce more number of units? Three products are there. A is giving 10 rupees, B is giving 20 rupees, C is giving 15 rupees of contribution. Definitely we will try to produce product B is higher number of units. Why means it is giving higher contribution. Okay, so first of all we check the demand of B. We produce we satisfy all the demand of B. Then if A is also having, so B, C is also having demand, we satisfy that. A is also having demand means that we satisfy. This is the basic order. Now, if we have unlimited resources, our preference will always be product B. Y means higher contribution. Let's say for example, in division X, we are having some limited hours. To produce A, B, C, we need mission hours. Mission hours. Total mission hours in division B is 9 hours only. Let's say 9 hours are there. Simple example, 9 only I'm taking. So in total in division B, we have division X, we have 9 hours only. Okay, to produce one product of A, we need, let's say 2 hours. To produce one product of B, we need 2 hours. To produce one product of C, we need 1 hour. This is the details information available, sir. So if I have unlimited resource, definitely I will go for B, then C, then A. This is the order. But so whenever we are having some limiting factor means the factor which is available in limited quantity. Okay, I cannot. So with 9 hours, I cannot produce unlimited units of A, B, C. Okay, so in this situation, which unit I have to produce with first preference, sir? For that, we need to calculate contribution per limiting factor. Contribution per limiting factor. Contribution per limiting factor is mission hours, right? So that's why contribution for mission hour. Okay, so from A, if you produce 1 unit of A, you will get 10 rupees contribution. When, sir? If you invest 2 hours, you will get 10 rupees contribution. That means 2 hours, 10 rupees contribution. Per hour, how much contribution? 10 divided by 2, 5. If you invest 2 hours, you will get 20 rupees contribution from B. Per hour, 10. If you invest 1 hour, you will get 15 rupees contribution. That means per hour contribution, okay, 15. What is our preference ranking here? If I give a ranking, preference ranking, first rank goes to C, second rank B, third rank A. Okay, so that's it, sir. Like this, we have to calculate preference ranking. So along with that, let's say maximum external market demand. Maximum external market demand is also given in the question. Let's assume maximum external market demand is also given in the question. That is 2 unit, 1 unit, 2 units, 1 unit, 1 unit. Okay, so this is the information we are having. So they will give this contribution information, they will give this mission hours information, they will give this external market demand information. With the available information, whenever there is limiting factor, we have to calculate contribution per mission hours, preference ranking we need to calculate. Let's say now, so how to calculate product mix, optimal product mix. Optimal product mix. How to calculate optimal product mix means mission hours, total mission hours available. How many hours available? 9 hours. Here we are given 9 hours. Okay. So now I'm having some limited hours. With first preference, I have to produce which unit? Why, see, sir? Higher contribution per hour. So with first preference, let's say I'm producing product C. How many units I will produce? Whatever the maximum external market demand units that I will produce 1 unit only. 2 units will I produce? No. Even if I produce 1 unit is the demand, external market demand 1 only, na? I will produce 1 unit only. Okay, 1 unit. To produce this 1 unit, how many hours I need? 1 hour. 1 into 1. That means 1 out of 9 hours, 1 hour I allocated to product C. Remaining hours 8. With second preference, which product I have to produce? Second preference B. Okay, B. External market demand of B 1 unit. 1 unit. To produce that 1 unit, how many hours are needed? B 2 hours. Okay, 1 into 2, 2 hours. Surplus hours available 6. With third preference, I will go to product A. How many units is the demand? 2. 2 units required. Okay, for each unit, how many hours? 2 hours. 2. That means 4 hours we have used for product A. 2 is the surplus hours. Finally, after producing ABC, we have 2 surplus hours. Now, this is the situation of division A. Now, suddenly division Y is coming and asking division X for 3 units of B. Okay, division Y manager asking division X to produce and send transfer 3 units of B. Okay, so to produce 3 units of B, 3 units of B, how many hours I need, sir? 3 units into 2, 6 hours I need. Okay, so surplus hours we are having is 2, surplus 2. That means we need 4 hours now, but which are not there in our division. Okay, we have 9 hours only. With our optimal product mix, we have used some 7 hours. We are surplus hours are 2 hours only. In this situation, division Y is coming and asking for 3 units of B. For that, we need 6 hours, surplus hours 2, remaining 4 hours. Now we need, sir. Okay. So for this 4 hours, what we have to do, sir? Foregoing. Which foregoing? Okay, okay. Sacrifice external sales of that any one of the product. Which product means A? Why A, sir? Okay, so out of this, I need product B. For that, I need 4 hours. Okay, so yes, we are not having this 4 hours. One thing we can do is like increase the capacity. To increase the capacity means you have to purchase the machine. For that, you will incur capital investment. Opportunity cost will be there. That is different case. Okay, if capital investment is not there, okay, with the available hours only we can do adjustments. How to adjust means, so out of these 7 hours we have to do some sacrifice. Okay, so I have to do external market sale of A or B or C. Out of this A, B, C, one product sales I have to sacrifice. The question is which product sales you will sacrifice? A. Why A means, okay, you will sacrifice A external market sales. Okay, so why A means, for product A we are having least contribution per mission hour. Okay, we can sacrifice product A. So now sacrifice, we need 4 hours. This 4 hours we are taking from which product? 4 hours taken, 4 hours sacrificed by A. That means we have 4 hours enough. Okay, we can produce, sir. Now in this situation, what is the transfer price? Transfer price is equal to, so what is the basic formula is like variable cost plus opportunity cost. So generally variable cost. What is the variable cost of producing a product B? 9 rupees, that was given in the question. Okay, variable cost. So transfer price is equal to variable cost plus opportunity cost. Generally variable cost only. Okay, so variable cost how much, sir? 9 rupees. But so just because of transferring 3 units of B to Y, we are doing some sacrifice. For that sacrifice, there will be some cost. Na? What is that cost, sir? Okay, I am sacrificing 2 units of A external market sales. If I sell these 2 units in the external market, how much contribution I would have got? For each unit of A, 2 rupees. 2 units, if I sell these 2 units in the external market, for each unit 10 rupees, 20 rupees I am sacrificing. So this 20 rupees is nothing but what? Opportunity cost. Now to this transfer price, from the transfer to the division B, I need to recover that 20 rupees opportunity cost as well. Okay, so opportunity cost, consider opportunity cost. Okay, so how to calculate that opportunity cost? How to recover that opportunity cost, sir? Variable cost 9 rupees plus what is the opportunity cost? 2 units of A. If I sell in the external market 10 rupees contribution, I would have got 20 rupees. Now this 20 rupees I need to recover from transfer to a Y. Okay, so this 20 rupees is total sacrifice. Now this 20 rupees I need to recover from how many units of transfer? How many units we are transferring, sir? How many units of B we are transferring to Y? 3 units. Whatever the number of units you are transferring, so to that number of units, recover that 20 rupees. That means 20 divided by 3. 9 plus 20 divided by 3. 9 is the variable cost per unit, sir. 20 rupees overall opportunity cost. That you need to recover from 3 units. How much? 6.67. That means 15.67 is the transfer price. Okay, So how to calculate transfer price in case of limiting factor? So first of all, as usual, calculate preference ranking. How to calculate preference ranking means contribution per limiting factor unit preference ranking. Calculate the optimal product mix as usual. Okay, so after calculating optimal product mix, check whether we have surplus capacity or not. Here we have surplus capacity of 2 hours. Okay, so how many units? Division Y is asking 3 units of B. But to produce 3 units of B, we need 6 hours, 2 only the surplus hours. Okay, so subtract the 2 hours. Additionally, we need 4 hours. Now for that additional hours, we have to do sacrifice. Which units you can sacrifice means here we are taking A, Y means contribution per limiting factor unit is low. Okay, so now I have to take this 4 hours from product A. If I take this hours from product A, I'm foregoing, I'm losing, I'm sacrificing product A sales in the external market. How many units of sale I'm sacrificing means with that 4 hours I have taken, with this 4 hours of A, I can produce 2 units of A and I can sell in the external market. For the 2 units, each unit 10 rupees, 20 rupees, I would have got. See, if I, so see, with that 4 hours, how many units we can produce, sir? 4 hours, how many units we can produce means, see here, mission hours, for each unit 2 hours. We are taking 4 hours from A. So, for 2 units, I can produce 1 unit. 4 divided by 2 means 2 units I can produce, or else leave it. 4 hours I am taking from product A. Each hour contribution is how much? 5 rupees, hourly contribution. 4 hours into 5 rupees, 4 into 5, 20 rupees. Or else we can calculate like with that 4 hours I can produce 2 units, each unit 2 hours. Okay, so 2 units into 10 rupees per unit contribution 20. Anyway, is same. Here I have calculated hours point of view. 4 hours, each hour 5 rupee, 20 rupees. Or else 2 units we are sacrificing for each unit contribution 10, 20. Same calculation, 2 ways. Okay. Anyway, so how much opportunity cost there we are sacrificing means that we calculate. This 20 rupees we need to recover from 3 units of transferring units. Okay, per unit 6.67. Okay, now what is the transfer price means? Variable cost plus opportunity cost. That's it, simple. This is the point, sir. So we need to check whether we are doing any sacrifice or not. Okay, so along with the variable cost, what is the minimum transfer price for transfer or division means variable cost only. Okay, along with that variable cost, sometimes we need to check whether we are doing any sacrifice or not. If there is any sacrifice is there means we need to recover opportunity cost as well. That is the main point. That's it. Now we shall do one problem, sir. With that you will understand. Go to the workbook. There, question number 6, study material question number 20, new material 3.3.8. Read that question once. Read this question. Done. Question number 6. Division A is profit center. Okay, which produces three products X, Y, Z. Okay, each product has external market as well. The details are as follows: X, Y, Z. Three products are being produced by Division A. External market price, that means nothing but selling price. Selling price per unit 48, 46, 40. Okay. Variable cost 33, 24, 28. Variable cost. Can we calculate the contribution? 48 minus 33. 15, huh? Okay. 46 minus 24. 22, huh? Super. 15, 22, 12. So, but Y is having higher per unit contribution. But that is not the case. We have to check limiting factor. What is the limiting factor here? Labor hours required per unit in division A is 3, 4, 2. Okay, whether that is the limiting factor, yes, at the end, if total hours available in division A are 3800, 5600. So with linkage to that labor hours only, they are giving some conditions. That means that labor hours is the limiting factor. Okay, so what is the contribution per limiting factor? 15 by 3, 22 by 4, 5.5. Okay, 12 by 2, 6. What is our preference now? Product Z first preference, product Y second preference, X third preference. Okay, so now product Y can be transferred to division B. Yes, but the maximum quantity that might be required for transfer is 300 units of Y only. Y is asking for, sorry, B is asking for 300 units of Y. Okay, so the maximum external sales, maximum external demand is X 800, Y 500, Z 300 units. Okay, we have already calculated preference now. So first they are asking what? See, instead of receiving transfer from product A, product Y, division A, division B could buy similar product in the open market slightly cheaper price of 45 per unit. Okay, what should be the transfer price for each unit of 3000 units of Y if the labor hours available in division A 3800, 5600. Now they are asking for us what? Transfer price. From whose point of view means division A point of view. Okay, division B point of view also we say. Okay, so first thing we need to calculate as limiting factor is given. Are you able to identify that labor hours as a limiting factor? Yes, at the end they have given limited hours now. Okay, so that's why labor hours is the limiting factor. We need to calculate contribution per limiting factor unit or contribution per labor hour. Okay, after calculating that, so contribution per labor hour, give the preference ranking. Okay, see first one, taking point A, so we have how many maximum hours? 3800. If maximum hours available are 3800, with the first preference, which product I need to produce? Z. What is the maximum demand of Z? 300 units. 300 units. 2 is what? 2 hours. Okay. 200 into 6. 600 hours. Surplus 3200. Okay. With the second preference, we have to produce Y. What is the demand? 500. 500 into 4. 2000. Surplus 1200. With the third preference, we need to produce X 800 into 3. 2400 is not available. Only 1200 is available. Okay, 0 hours. Okay, that means how many units we can produce? So 1200 divided by the available 3. 400 units only we can produce. Okay, so we are not even having surplus hour to satisfy complete demand of X. Okay, in this situation, who is coming here? Division B is coming and asking for 300 units of Y. Okay, so if you want to produce 300 units of Y, okay, how many hours needed? 300 into 4 hours per unit. We need 1200 hours, 1200. 1200. Okay, so we need 1200 hours now. So do we have any surplus hours? No, zero hours. Surplus hours are not there. That means this 1200 hours we need to take from other any product external market demand. We need to do some sacrifice. Okay, which product we sacrifice, sir? X, Y, X means least contribution per hour. Okay, so how many hours are being used for X? 1200 hours, ra? 1200 hours. Okay. So now take this 1200 hours from where? From product X. Okay, I have taken 1200 hours. Okay, I can produce Y 300 units enough. Now we need to calculate what? Transfer price. Transfer price is equal to variable cost plus opportunity cost. What is the variable cost of Y? Variable cost of Y is 24. Okay, plus what is the opportunity cost? We are sacrificing how many hours of X? 1200 hours. We are taking how many hours from X? 1200 hours from X. Okay, so if you take this 1200 hours from X, okay, so from each hour, how much contribution you would have earned? Hourly contribution, I'm asking. So just look at this calculation and can you tell me the hourly contribution per product X, Y, Z? Contribution divided by number of units. Hourly contribution 5, 5.5, 6. Hourly contribution. Per unit contribution 15, 22, 12. Are you getting the difference? Okay, per unit contribution per hour. Okay, here I am taking 1200 hours from X. For each hour, X will earn 5 rupees contribution. 1200 into 5. Okay, 6000 is the opportunity cost. So this 6000 has to be recovered from transferring units. How many units we are transferring? Y 300 units. 6000 divided by 300. 20. 24 plus 20. 44. That minimum transfer price division A will accept is 44 rupees. Okay. So will division B can accept at 44? Maximum how much B can offer? Look at that question and tell me. Look at this question and tell me. Maximum transfer price from B point of view. Same formula, sir. Transfer price range. Maximum transfer price. How to calculate? Maximum transfer price. External market price. Na? Okay, what is the external market price? In the question, how much they have given? 45 rupees. Directly given. Na? 45 rupees. That means B maximum that will offer 45 rupees. A minimum at least may, so A na? Yes. Division A at least they will accept at 44 rupees. Okay, minimum 44, maximum 45. Okay. So anyway, A is telling 44 rupees, B is ready to accept 45. So 44 is the transfer price. Or else if you want to write that range, you can write minimum from A point of view 44, maximum from B point of view 45. Okay, are you okay with this calculation? Okay, na? Okay, now same calculation 5600 hours. You guys have to tell, sir, now. Again, let's calculate the optimal product mix. In case B, how many maximum mission hours we have? Labor hours we have? Labor hours available is 5800. 600, na? 600 surplus. Okay, okay. So 5600. With first preference, we need to produce product Z. In how many units? 300 units. 300 units into how many hours per unit? 2 hours. That means 600. Okay. 5000 surplus. From with second preference, we need to produce Y. How many units of Y? 500 units of Y. For each unit 4 hours. 2000 hours. Okay. And we have 3000 surplus. Okay. Third preference, produce X. How many units? Our maximum demand 800 units. 800 units into for each unit how many hours? 3 hours. 2400 hours. Okay. So surplus is 600. Okay, now B is asking for how many units of Y? Y 300 units. Okay, for each unit, how many hours needed? 4 hours needed for Y. Total 1200 hours I need. Out of this 1200 hours, surplus hours 600. Okay, so remaining hours we need 600 more hours. Additional hours required. Okay, additional hours required 600. Now this 600 we have to sacrifice. From which product we have to sacrifice? Okay, if from X, okay, take this 600 hours from X. Okay, satisfied. Now, what is the transfer price, sir? Transfer price, variable cost. Is there any sacrifice opportunity cost is there? Yes, we are doing sacrifice. Na? Okay, variable cost plus opportunity cost. What is the variable cost? 24. Okay, so what is the opportunity cost? Now tell me, 600 hours we are sacrificing. For each hour contribution is 5. So that means 3000 divided by 310. That means 34. Minimum transfer price from A point of view is 34. Maximum transfer price B can offer is 45. Okay, that's it. Okay, in this situation they can negotiate. Okay, so B is ready to give 45. A will accept at least 34. That's it, simple. Okay, question answer is there in the workbook. So clear explanation note points are also there. Okay, so if you go through that points, they will explain. Okay, this is what happened. This is sacrifice we are doing. That's why this calculation and all. So answer is there now. You don't worry. And anyway, I have shared one PDF now, handwritten notes. In that, so clearly, I have solved this problem. Okay, if you want to refer later, you can refer. Okay, this calculation, complete calculation is there. Clearly, I have written there. In Eo Batch WhatsApp group, I have shared that PDF. Later, if you want to take, so take that printout, or else fine. Now, what is our next target question is? Any doubts in this question? Okay, that is most important point, sir. Whenever there is limiting factor, you need to calculate contribution per limiting factor. But in throughput costing, we calculate throughput contribution per limiting factor. That is the point. Okay, same point will be there in linear program planning. Okay, and same point is also there in marginal costing. So same question, marginal costing, more or less same question only. Okay, now this one, sir. The seventh question, study material question number 24, very, very important. Okay, so in this question, we have 4 points, 4 alternative points they are asking. But, okay, so 4 points they are not asking in the examination. First 3 points, second point, third point, 4 point. Like that, out of 4 points, 3 points are asking, being asked. Why, sir? Why means 4 points means lengthy question. They so transfer pricing question is for 3 marks only, na. So that's why they are sorry 7 marks only, na. That's why they are asking 3 points. So go through that question. So new material 3.3.9, new updated version. Old one 16, na. Okay. So go through that question. Done. Completed. See, XY company has a profit center, division Y and division X and Y, making products X and Y respectively. Each unit of Y requires 1 unit of X, and Y can sell maximum of 50,000 units in the external market, selling price of 150 for unit. X 150 per unit కదా. See, X has the capacity to produce 1 lakh units of X. The variable cost per unit is 12 rupees. Fixed costs are 7 lakh 20,000. X can sell the following quantities in the external market. Okay. So price, different price options are given. If price is getting increased, demand is reducing. If price reduced, demand increases. Price increases, demand reduces. Same. Okay. So if you move from 18 to 20, demand reduces. If you move from 22 to 18, demand will increase. Okay, what is the story they are telling in this question, sir? The story is first one. Two departments are there. Division X, division Y. Yeah? Okay. Division X, division Y. Okay. So for each unit of Y, they need 1 unit of X, right? For 1 unit of Y, they need 1 unit of X. Okay, so Y can sell how many units in the external market? 150 units, selling price 150. That means Y need 50,000 units. So they are selling in the external market for external market price 150 rupees. Okay, fine. This selling price, external selling price. Okay, write it here like this. Now, so what is the capacity of X? What is the capacity of X? 1 lakh units. Variable cost, X can produce 1 lakh units. Variable cost 12 rupees. Fixed cost 7 lakh 20,000. So under selling price, X external market selling price, X can sell the following quantities in the external market. So for the same product of X, they have given external market selling prices. Okay, selling price and demand quantities. Now, so the very important point, sir. Whenever there is different prices and different quantities, okay, price and demand relationship is given like this. This kind of information is given. Now we need to fix the selling price. Which one is the best selling price, sir? How to calculate that best selling price means we have to calculate contribution. See, what is the variable cost here? Variable cost 12 rupees, 12 rupees, 12 rupees, 12 rupees, 12 rupees. What is the contribution per unit? 18 minus 12, 6, 20 minus 12, 8, 10, 12, 14. Okay. So we will get maximum contribution 14 rupees if our selling price is 26. But we should not fix the selling price 20 rupees, 26 rupees. Why, sir? Demand quantities are different, no? Okay. For that, we need to calculate a total contribution. Now, let's calculate total contribution. So, 84,000 units, per unit contribution 6. How much? 5 lakh 4,000. No? 40,000. No? 5 lakh 4 na? Okay, fine. Okay, now next one. 6 lakh 8,000. 7 lakh 7 lakh 60 na? 68 wow. 7 lakh 68,000. 7 lakh 56,000. Okay, from contribution if you subtract, so anyway, fixed cost is fixed only na. Okay, to get the profit from the contribution, we subtract fixed cost. Whatever the price you fix from the contribution, fixed cost is constant. That means we can take a decision based on total contribution. Now, so all the figures are there in the screen, sir. Looking at those figures, can you tell me which one is the best selling price? 24. Why 24? Total contribution is maximum at 24 selling price. That means even though per unit contribution 14 highest at 26 selling price, we should not fix 26. Why means demand quantities are different. We will get different total contributions. First point. Okay. So this kind of information sometimes in MCQs will be given, sometimes in marginal costing will be given. So here we have this kind of information. Okay. So in marginal costing we have one question, sir, selling price fixing. Okay, in that directly they will be giving this kind of information. If this kind of information is there, different selling prices, different quantities, what we need to calculate? Calculate total contribution. Okay, selling price minus variable cost, contribution per unit into number of units, total contribution. Okay, the selling price or quantity at which total contribution is maximum, that is the best selling price. Okay, our best selling price is 24 rupees. Okay, at this level we could sell 64,000. So for which department, sir? This is for X department. X can fix selling price of 26 in the external market. Okay, that capacity is 1 lakh units capacity. Okay, best quantity of selling is 64,000. It can sell 64,000 in the external market. So X has 1 lakh capacity. 1 lakh capacity, 64,000 it can sell in the external market. Surplus capacity 36,000 units only. Now come to the question again. What is the point they are asking? Assume no stock to build up for X or Y. Okay, Y can purchase its requirement from the external market at 22 rupees. Okay, 22 rupees. It can purchase, Y can purchase from external market, but it has to incur bulk transportation cost of 1,50,000 for any quantity. Underline transportation cost of 1,50,000 for any quantity which will not be incurred on transfer from X. Okay, if Y want to purchase from external market, 22 rupees is the purchase price. And also they will incur some transportation cost of 1,50,000. Okay. So in this situation, can you tell me the maximum transfer price from Y point of view? Maximum transfer price. How to calculate? External purchase cost. Okay. So external market price 22 plus 3. 1,50,000 is the transportation cost for how many units? Y need 50,000 units. 25 rupees. Maximum 25 Y can offer. Okay, now required. Assuming no demand from Y, what is the best strategy for X? If Y is not asking any units, X will fix which selling price? The price at which they are getting maximum profits. Okay, see this calculation, sir. This calculation. Okay, so total contribution maximum 64,000 it will sell, fixing 24. Okay, assuming no demand from Y, X best strategy is selling 64,000 units at 24 rupees selling price. That was also there in answer. Calculated the total contribution, writing that point enough. Okay, now point 2, sir. What will be the minimum transfer price? Minimum transfer price, X will agree if X has to supply 50,000 units to Y. What price Y offer at the maximum? Second point, nothing but transfer price range. What is the maximum transfer price from Y? What is the minimum transfer price X will accept? Okay, now so maximum transfer price you guys only told me now. What is that? 22 plus 3, 25 is the maximum transfer price. Now minimum transfer price. Okay, see minimum transfer price. How to calculate the minimum transfer price? We have already discussed. Surplus capacity is there, only variable cost. No surplus capacity, na. So add opportunity cost as well. Okay. From X point of view, so presently it is having capacity of 1 lakh units, selling 64,000 in the external market. Why 64, sir? That is the best strategy for X. 36,000 it is having surplus capacity. Now If Y is asking for 50,000 units, okay, first of all, X has to transfer 50,000 units to Y. Then remaining units are how many units? 50,000 only. So transfer to Y 50,000. Remaining 50,000 units will be there. This 50,000 units to the external market. Can you tell me, so if X is selling 50,000 units in the external market, how much contribution they will get? Look at this information, this table calculation and all. Uh, Last one. If you are selling, okay, if you are selling 50,000 units means 54,000 or less than 54,000. How many units? 50,000 units. We are selling 50,000 units. 50,000 units falls under this category. Then we can fix selling price 26 per unit contribution 14. 14 into 50, 7 lakh. Okay, so what is the optimal strategy of X? Getting 7,68,000. Okay, so if X transfer 50,000 units to Y, X will get external market contribution 7 lakh only. Wow, excellent, madam. So what is the difference? How much? 68,000. Are you getting that point? Super. No, excellent. Mind blowing. Okay, so this 7,68,000 to 7 lakh difference, 68,000 difference is opportunity cost. Okay, see, originally X best strategy is getting 7,68,000 contribution. But if X transfer 50,000 units to Y, it could sell 50,000 units only in the external market. If it is selling 50,000 units only in the external market, it can fix the 20 price, selling price 26 rupees, contribution per unit 14 rupees, 7 lakh contribution it will get. The difference, previously 7 lakh 68, now it is getting 7 lakh only. Why this difference occurred means just because of the transfer. That means the transfer. Okay, just because of the transfer, the opportunity cost is 68,000. Now, what is the transfer price? Means transfer price is equal to variable cost plus opportunity cost per unit. Okay, opportunity cost per unit, sir. So what is the variable cost? 12 rupees is the variable cost. What is the opportunity cost? 68,000. This we need to recover from how many units? 50,000 units. 1.36. 13.36 is the minimum transfer price that X will accept. Okay. Now, any doubts in the second point? Now, look at the third point. What is the third point? If Y is acceptable to partial supplies. Okay, so if Y take partial supplies, okay, so what will be X best strategy under no compulsion to transfer, but within with the option to transfer as many units as it wants to, what will be the quantity that X will transfer and corresponding price, assuming both divisions are agreed to share the benefits of transfer equally. So first one, okay, so even partial supply, so Y actually need 50,000 units, sir. Even if X transfer partial supplies, Y will accept. Okay, so generally what is the X best strategy? Optimal strategy of X is 1 minute. Okay, so X best strategy is 64,000 units selling in the external market. Okay, in that situation, it is having surplus capacity of how much? 36,000. So X will definitely go for its optimal strategy. Remaining 36,000 only, it will transfer. Okay, how many units X will transfer if X there is no compulsion to transfer 50,000 means 36,000 only. Okay, so what is the next point? What is that question? X best strategy and transfer. What will be the quantity X will agree to transfer corresponding price, assuming both divisions are agree to. Okay. So what quantity will X will accept prefer to transfer means 36,000 only. 1 lakh is the capacity, 64,000 is the best strategy, remaining 36,000 only X will transfer. Now next point, agree to transfer and the corresponding price. What is the corresponding price X will transfer? Assuming both the divisions are agreed to share benefits of transfer equally. Now in this situation we need to fix again transfer price range, sir. Now what is the story? X is having 1 lakh capacity, 64,000 best strategy, remaining surplus 36,000 only. Y need 50,000. Okay, but X is transferring 36,000 only. If Y takes 36,000 only, then remaining 14,000 it has to purchase from the external market. Now can you tell me the transfer price range? Range means minimum price, maximum price. Minimum price X will offer is how much? Only variable cost. Only variable cost 12 rupees. There is no any sacrifice, no opportunity cost. Maximum price Y will offer. External purchase cost generally, external market price. External market price 22 rupees. But 3 we should not add. Why, sir? Even for small quantity of 14,000 units, X anyway has to incur bulk transportation cost 1,50,000. Then why will not give that benefit to X? Why, sir? Are you getting that point? Okay. So previously Y will offer 3 rupees to X. So external purchase price 22 rupees. Okay, plus 3 rupees Y is offering to X. Why additionally 3 rupees Y is offering to X means, as it is if Y purchase from external market 1,50,000 transportation cost they are incurring. Purchasing from X, it will not incur the transportation cost. Na? If Y purchase from X, it will not incur the transportation cost. That's why anyway external market purchase I am incurring 3 rupees. No, okay, take that benefit also. That's why Y is giving previously. But now X is transferring 36,000 units only. For this 14,000 units, Y has to go to external market. Again for that 14,000, Y will incur 1,50,000 cost. Then Y department will give this 3 rupees benefit to X. You are not getting this point, huh? So now read this point. Transportation cost of 1,50,000 for any quantity, which will not be incurred on transfer of X. Any quantity means even if Y purchase 1 unit from external market, it will incur transportation cost of 1,50,000. Okay. So previously Y is offering 22 plus 3. Y means okay, if all the quantities X transferring, it will not incur transportation cost. No? Y can give that benefit to X. But here in this point, X is supplying partial quantity only. Remaining 14,000 Y has to purchase from external market. In that situation anyway, so Y is incurring 1,50,000 transportation cost. Na? It is paying in the external market. Why that benefit they will pass to the X department? Okay, it is giving benefit of external market price only. It is not getting benefit of transportation cost. So that's why maximum Y will give external purchase price of 22 rupees. External market price of 22 rupees. Are you getting this point? Okay. So now if what is the point they are asking in the question means minimum transfer price 12, maximum transfer price 22. What is the difference? 10. 10 rupees is the benefit. Let us assume this 10 rupees is as profit. Okay. So this 10 rupees has to be distributed between them equally. 5 rupees, 5 rupees. Okay. 12 plus 5. What is that? 17 rupees. 22 minus 5. 17. Okay. Now 17 is the transfer price. Done. Okay. Last point. What is the best strategy of the company? Will the company overall strategy differ from individual division strategy? Compute the benefits, advantages, disadvantages, indifference between the divisional best company best strategies. Present the relevant calculations to substantiate all your answers. Okay, now fourth point is what, sir? They are asking from overall company point of view. When you look at this decision from overall company point of view, it is nothing but make or buy decision. Okay, see, overall company point of view, if you see, Y need 50,000 units. 50,000 units. That means company need 50,000 units. Okay, transferring from division X to Y. Transferring from division X to Y means nothing but making, internal making. Okay, so purchasing from external market means nothing but this is buy decision. Nothing but simple make or buy decision. Okay, so in make or buy decision, so how to select the best strategy means calculate the cost under making option. So calculate the cost under buying option. If you buy from external market, what is the external? So how many units needed? 50,000. What is the external purchase price? 22 rupees. 50,000 into 22 plus transportation cost is there na 1,50,000. So total how much? 12 lakh. Okay, so making, in making option, so how much overall company, from company point of view, how much company will incur to produce 50,000 units? Only variable cost, no? Okay, what is that variable cost? 12 rupees. What is that cost? 6 lakh. Making cost. Along with this, if X produce and transfer to Y, there is some opportunity cost. We have discussed previous second point. So X is having some opportunity cost of 68,000 just because of transferring to Y. That means total cost here is 6,68,000. Okay. So if you make in-house, so if you make in-house, what is the cost of making is 6,68,000. How 6,68,000, sir? 6 lakh is making variable cost. 68 is opportunity cost. Where opportunity cost, sir? Here we have calculated that one. Okay, 7,68,000 to 7 lakhs. 68 opportunity cost. This 68,000. Okay, making option cost 6,68,000. Buying option cost 12,50,000. What is the difference? 5,82,000. Okay, this is the situation, sir. Now you guys tell me which option is better option. Making option. Okay, so but we directly won't say making. Internal transfer is best option from overall company point of view. Okay, so cost if X transfer to Y 6,68,000, cost if Y purchase from external market 12,50,000, which one is the best, sir? Okay, making is the best. That means internal transfer is the best. Done? Any doubts? Okay. Okay, so next one, sir. Finally, last question, we have one question. So here we can calculate indifference point as well in this question. Indifference point means what, sir? Indifference point means, okay, so when you have two alternatives, cost in two alternatives is equal means that is indifference point. Okay, so see, so generally we know that formula indifference point, change in fixed cost divided by change in variable cost. Here we have two alternatives, make, buy. So what is the variable cost here? Making option variable cost is 12 rupees. Buying option variable cost means complete market price 22 rupees, right? What is the fixed cost here? Here fixed cost is opportunity cost 68,000. What is the fixed cost here? 1,50,000. Transportation cost is fixed cost here. Okay, so now if you want to calculate at what number of units there is indifference point means, so indifference point, let's say number of units, that point we don't know how many units, indifference point units we don't know, that we whatever we don't know, that we assume as X. Now let's say X is number of units. Okay, so now so that indifference point X is equal to change in fixed cost divided by change in variable cost. What is the difference of fixed cost? 82,000. So what is the difference in variable cost? 8,200 units is the indifference point between two of them. Okay, so below indifference point, which one is preferable? Above indifference point, which one is preferable, sir? Okay, so below indifference point, the alternative with lower fixed cost is preferable. Sorry, alternative with lower variable cost is preferable. So above indifference point, lower fixed cost is preferable. It is 8,200, 82,000. What is this? This difference is 82,000 divided by 10. 8,200 units is the point. Next, above indifference point, which one is preferable means the alternative with lower fixed cost. Sorry, lower variable cost. Above indifference point, lower variable cost is preferable. Below indifference point, lower fixed cost is preferable. Both are same here. Okay, variable cost is less, fixed cost is also less here. Okay, so most probably we will get making option only, but indifference point is 82,000. We cannot do that kind of bifurcation here. Okay, that is how we can calculate indifference point, sir. Just random calculation only, that was not asked in the question. Next question. Let's go to the next question. Question number 8. What I said, below indifference point, which one is preferable? So let's say we have calculated indifference point, below indifference point, above indifference point. Above indifference point, low variable cost. Below indifference point, low fixed cost. Okay, so if I told you in reverse, please correct. See, question number 8. Okay, this indifference point and all we will discuss while discussing marginal costing MCQs and all. See, go through this question. December 23 attempt, December 24 attempt. This question is not there. There in additional questions. Additional questions. Go to the additional questions. From the end, check December 23 attempt question. The same, I think the same exact question is not there, but with some numbers change. Okay, this is I think December 24 question. There we have December 23 question. Some numbers change, same question will be there. So look for December 23 question in old workbook. Old version. This one only. This one. What is the difference for the two questions are same? December 23, December 24 question are same, but numbers are different. That's it. Now let's do this question. Yes, this is latest attempt question. That's why I have removed that question, placed this question. Okay, anyone is fine. Same model. Okay, just go through that question. Go through that question. See, uh, Roxin Limited has two divisions, Division M and Division N. Division M manufactures a product A15 which it sells outside the market as well as to Division N, which process to manufacture Z25. The manager of Division N has expressed the opinion that transfer price is too high. The two divisional managers are about to enter into a discussion to resolve the conflict, and the manager of Division M is to supply him with some information prior to the discussion. Division M has been selling 50,000 units to the outsiders, 10,000 units to Division N, all at 25 per unit. Okay, now, till now, what is the story means? Two divisions are there, Division M, Division N. Division N is making A25, Division N is making some other product. Okay, so Division M is uh, Division M and Division N both are Z25 it is making, sir. Sorry. So from taking A25 from M, Z is making, sorry, N is making Z25. Okay. Now the question is, the manager of Division N has expressed opinion that transfer price is too high. Okay, so M is transferring to N some units, but N is feeling like transfer price is too high. They are about to enter into some agreement, so some negotiation meeting is going to happen. In before that meeting, so Division M manager of Division M is to supply with him some information for discussion. So what is that information means? Division M has been selling 50,000 units to the outsiders, 10,000 units to the Division N, all at 25 rupees per unit. It is not anticipated that these demand will change. The variable cost per unit is 15 rupees and the fixed cost are 3 lakh. Divisional investment on assets is 12 lakh. Now see this information. Currently M is providing this information. So M is selling 10,000 units to N, 10,000, 50,000 units to the external market. Both are at 25 rupees price only. External market selling price, transfer price, both are 25 currently. Variable cost is 15, fixed cost is 3 lakhs, net assets is 12 lakhs. Okay, now what is the discussion is like, the manager of Division M anticipates that Division N will not transfer, will want a transfer price of 22 rupees. What is the current transfer price? Are you able to understand this one? The story, two departments are there, MO, N. Okay, so N is feeling like transfer price is too high. What is the transfer price means? 25 rupees currently. M is selling 50,000 units to external market, 10,000 units to N. My external market price, transfer price, both are currently 25 rupees only. Now, if manager, so manage, they are going to enter into an agreement, Division M transfer or Division N transferee division. Okay. Division M is expecting like Division N manager will want a transfer price of 22 rupees. Okay, he is expecting this Division N manager will ask for 22 rupees. If he does not sell to Division N, okay, 40,000 of fixed cost, 2 lakh of assets can be avoided. The manager of Division M would have no control over the proceeds of sale of assets. Is judged primarily, this is the line, judged primarily on his rate of return. Rate of return means, so we have already discussed at the beginning of the chapter, four types of investment centers are there. Sorry, four types of responsibility centers are there. If the responsibility center is investment center, their performance will be judged based on return on investment. Okay, here manager performance will be judged based on return on rate of return. That means nothing but return on investment. Okay, required analyze, should the manager of Division M transfer its product at 22 rupees to Division N or not? That is the question. Okay, so first alternative here we have to calculate. So as manager performance can be judged based on return on investment, we need to calculate return on investment. That is the first point you have to keep in mind. Okay, so how many alternatives are there, sir? First alternative, current position. What is that current position means? Currently they are selling 50,000 to external market, 10,000 to internal transfer. So Both are at 25 rupees, 25 rupees selling price. Transfer price 25, external market price 25. Okay, so second alternative is selling externally 25, external market 25, but transfer price division N manager asking for 22 rupees na. Okay, so this is second alternative. Third alternative is not at all transferring. Not at all transferring means if they are not transferring, they can save some assets, some cost, fixed cost they can save. That means three alternatives are there, sir. Now we need to calculate what return on investment in these three alternatives. How to calculate return on investment, sir? How to calculate return on investment means return divided by investment. What is the investment? Okay, see, calculation of return on investment in each alternative available. How many alternative? Okay, so transfer, external market price, both are 25 current position. Okay, transferring to division N at 22 rupees. Not at all transferring. That was given in the question itself. Okay, we don't need to think for first existing alternative, 22 rupees alternative. If manager would, if he is not sell to division N, he can save some assets they are saying. Na? That means no transfer alternative, three alternatives. In these three alternatives, let's calculate return on investment. Okay, see. So how to calculate return on investment means investment, so profit divided by investment is our return on investment. Okay, so what is the investment on assets? In first alternative, existing alternative, investment 12 lakhs given in the question. For which department, sir? For which department we are calculating return on investment? Division M you are calculating. Why means division M has to take the decision whether to transfer at 22 or not. Okay, so investment 12 lakh. Second alternative also 12 lakh. In third alternative, so they can save some assets. See, 2 lakh assets they can save. 2 lakh assets they can save. That means 12 lakh minus 2 lakh, 10 lakh only the net assets. Okay, so now we need return on investment. Return we need to calculate. Return means nothing but profit. How to calculate profit, sir? Sales, total sales, external sales or internal transfer? Sales minus variable cost minus fixed cost. Now come to this point. So sales, external market, they are selling how many units? 50,000 units into 25 rupees is the selling price. Three alternatives 25. 50,000 into 25. 12 lakh 50, 12 lakh 50, 12 lakh 50. In first alternative, they are selling transferring at 25 rupees. How many units? 10,000 units. 10,000 into first alternative transfer price 25, 2 lakh 50. Second alternative transfer price 22, 2 lakh 20. In third alternative, they are not transferring. Okay, so total revenue minus variable cost, less cost. What is the variable cost? Variable cost at the rate 15 rupees. Okay, total variable cost 50,000 units plus 10,000 units. Total variable cost is 60,000 into 15, 9 lakhs. Yes, 9 lakhs. In second alternative also 60,000 units, 9 lakhs. Third alternative variable cost, can you tell me? So 50,000 units into 15 only. Why, sir? Why not 60 means no transfer? Na? 10,000 units not transferring means they won't produce. Okay. 50,000 into 15, 7 lakh 50,000, 9 lakh, 9 lakh, that is variable cost. What is the fixed cost? 3 lakh is the original fixed cost. Second alternative also 3 lakh. In third alternative, if you don't transfer, means you can save fixed cost. How much? 40,000, 2 lakh 60,000. Okay. So profit 3 lakh, 2 lakh 70, 2 lakh 40. What is the return on investment? Return divided by investment, 3 lakh by 12 lakh, 25%, 270 by 12, 22.5, 240 divided by 10, 24%. Okay. So if original alternative, existing alternative is not possible, out of remaining alternative, which alternative will division M manager will choose, sir? Division M manager performance will be judged based on return on investment. He will try to generate higher return on investment. So definitely existing alternative return on investment is higher. But so existing transfer price 25 rupees, division N manager feeling too high. He will not accept. Okay, so then division M manager will have two alternatives. Second one, third one. Second alternative, third alternative. We have three alternative. Na? So out of second alternative, third alternative, which alternative manager will choose? Third one. Third one is what? Not at all transferring. Okay, so if manager, division M manager transfer at 22 rupees, his return on investment 22.50. If he decide to not to transfer, his return on investment 24. Okay, his performance will be judged based on return on investment na, so he will go for third alternative instead of transferring at 22. Okay, that is the answer for first point. Analyze, should the manager of division M transfer to division N at 22 rupees or not? No, he will not transfer. Why means his return on investment is decreasing even below than alternative of not transferring. Okay, so that is the answer for first point. Okay, I will share that handwritten notes, or else here we have some clear solution. Okay, you don't worry about that. Next one, second point, assess lowest price that division M should accept. Lowest price division M should accept means the price which gives at least 24% alternate, 24% return. Okay, see, 22 rupees he will not accept. Okay, 25 rupees N is not accepting. What price they will accept means the transfer price which will give at least 24% return he will accept. Why, sir? No transferring alternative, he is getting the 24 now. That's why, okay, the transfer price which gives 24% return he will accept. Okay, now our return on investment, to calculate transfer price, division M manager should not transfer to, and his return on, okay, no transfer. Division M manager will accept transfer price which gives at least 24% of return on investment. Now, return on investment is equal to 24%. Okay, so transfer price we need to calculate, sir. Return on investment means return divided by investment, that is equal to 24%. What is, how to calculate return, sir? Sales minus total cost divided by investment 12 lakhs only, na? Transferring alternative investment 12 lakhs, that is 24%. So what is the sales? What is the sales means external market sales. How much, sir? External market sales 50,000 units into 50,000 units into 25, 12 lakh 50, 12 lakh 50 external market sales. Okay, transfer price is also sales, na? Okay, so we do we know the transfer price? No, that is only we need to calculate, na? So 10,000 into transfer price. This total is what, sir? Sales minus cost we need to calculate. So what is the cost? Variable cost. How many units? 60,000 units into variable cost. How much? 15. Total 60,000 units into 15. 9 lakhs. Okay. 9 lakhs. What is the fixed cost? 3 lakhs. Okay. Total revenue minus this total cost. You will get what? Return. Okay. Here we don't know the transfer price. In denominator 12 lakhs we know. Here 24% we know. Now the calculation, look at that calculation. If I bring this 12 lakh to the left side, 12 lakh into 24%, 2 lakh 88,000. Check. Okay. You're struggling to figure out. Are you guys okay with this calculation? First one. Okay. Second one, you're trying to figure out. Okay. Second one, what is the point we are calculating? Division M manager will accept transfer price, which should earn at least how much return? 24. Why 24 we are taking? If he transfers at 22, return on investment falls to 22.50. If he is not at all transferring, his return on investment 24. Okay, that means if first alternative is not okay, so he is going to which alternative? 24. That means division M manager needs 24 at least return on investment. Okay, so then division N manager will say like, if I give the transfer price which gives at least 24 percentage of return, is it okay for you? Then he says definitely okay, na? Okay, so division M manager will accept the transfer price which gives 24% of return on investment. Are you okay with this single liner? Okay, so they are not agreeing with 25. Why means division N manager feeling transfer price 25 is very high. That's why only they are entering into the agreement, so negotiation. Okay, this is not possible. Okay, remaining, so out of the remaining two alternative, 24 is the alternative they will choose. Okay, now division M manager needs 24% of return on investment. Okay, we have to fix the transfer price which gives at least 24% of return on investment. For that, we are taking return on investment, return by investment, sales by total cost, sales minus total cost. This is sales, this is total cost. Okay, this is investment. If you bring that investment, so 12 lakh into 24%, 2 lakh 88,000. Okay, 10,000 into transfer price, 12 lakh 50,000 minus this one is how much? 12 lakhs, 12 lakh 50 minus 12 lakhs 50,000. 10,000 into transfer price plus 50,000 equal to 2 lakh 88,000. 10,000 into transfer price, if you bring this 50,000 to the right side, 2 lakh 38,000. Transfer price is equal to 2 lakh 2 lakh 38,000 divided by 10,000. 23.8 is the transfer price. If you fix the transfer price at 23.8, so division M manager will get 24% of return on investment. He will accept. Okay, so minimum transfer price division M manager will accept is 23.8. Any doubts? Same question was there in December 23 attempt. Okay, with some numbers in some 18 rupees that was given. Okay, the same question with some numbers in December 24 attempt they have given, sir. Okay, so that means similar models are there with changing some numbers, they are giving repeated models. Okay, these questions are enough, but okay, I will mark two more questions here. If you have time, practice those questions as well. So here we have done, come to the main page. Here we have done, so methods of transfer pricing. Question number one is additional question. Question number 2 we have done. Question number 3 also done. 2, 3 done. Transfer price methods, residual income. Okay. After that, question number 2, 3 limiting factor discussed. Okay, divisional profit analysis. Question number 5 also discussed, I think. Strategic alternative. Question number 7 discussed. Question number 8 also discussed. Okay, so if possible, solve this 9th question and 10th question as well. We have done now, that question number is 9 only, na? 8, then 9th question also solve, try to solve. 9th question, June 25 attempt question. Okay, in June 25 attempt, they have asked a question, means that question will not be asked in December attempt. Recent attempt only they asked. Na? Next December attempt, how can they ask that question? That means, okay, you can leave this question. Simple. No? Okay, but if you want to solve this one, okay, so try this question later. If you get any doubts, answer, complete detailed answer is there. Okay, so handwritten solution also I have already provided. Okay, go through that question and answer. If you get doubts, means I will explain. Now, what are the other questions? Apart from the questions we have discussed, 9th question, 10th question. Also try this 9th one, 10th one. Enough, those questions are enough. Okay, so this 11th question is nothing but make or buy decision. Make or buy decision. 3 alternatives will be given in the question. Okay, make or buy decisions we need to take. So that is also easy question. Okay, so try these questions. If you get any doubts, I will explain. How many questions we have done? 2, 3, 4, 5, 6, 7 questions. 10th question. 9th question. Keep it as B category. 10th question. Okay, this is a make or buy, somewhat like make or buy. If you think from make or buy point of view, you will definitely understand that one. Okay, question number 11, one question is there. So if you want to try this one, 11th question. Enough. That main questions are enough, sir. Main questions enough. Okay, after first of all focus on this main questions, then if you want to solve any questions, then go to, first of all, be perfect with these main questions, then go to the additional questions. More or less similar models will be there. Okay, some easy questions, similar models will be there in additional questions. I think if you go to the additional questions, okay, if you go to the additional questions, limiting factor question, already one question we have done. Okay, that is only there. Okay, next one after limiting factor, again second one limiting factor. In additional questions, another limiting factor question. Okay, strategic alternatives. We have done one question. Okay, so in June 24 attempt, what they have done is like, okay, we have done that strategic alternative 4-point question, but here they have given 3-point question. June 25, same question. Okay, so alternative analysis, December 24th question means, okay, this is December 23 attempt question. Now, just now we have discussed December 24 now. This is December 23 question. Okay, similar questions are there in additional questions, same models. Okay, for each model, I have kept in main questions one question, additional questions, repeated questions. Okay, first of all, be perfect with that main questions. We can definitely solve. Okay, so examination questions. Okay, we have, I left with how many questions? Try this 11th one, 10th one, enough. Okay, this 9th question, June 25 attempt question only. That's why I'm telling you like, okay, leave that model. Immediate attempt, they may not ask now. So that's it. Thank you all guys. Yeah, hi guys. Hi. Those who are watching live class. Okay, thank you very much for your patience levels and all. Uh, Sir, what about the left out topics? Okay, left out topics, product life cycle, asset life cycle, probability. I will discuss some. I will discuss. You don't worry. Those three topics are small topics only. Asset life cycle costing. So nothing but investment decisions in SFM. Okay. So some small calculations are there that will take 30 to 40 minutes. Maximum that will take half an hour. Okay. Coming to next product life cycle, two problems are there, half an hour. Probability, very easy chapter, half an hour. That means 1.5 hour. So that three chapters I will cover next coming 3-4 days. Okay, that's it. Uh, thank you all guys. Bye.